there's going to be a meaningful correction at some point over the course of 2026.
We want to make sure we're managing risk well next year.
What the market is saying is that earnings matter more than ever right now.
It is encouraging that we are seeing broader participation in the rally.
Investors need to be ready for surprises and the unexpected.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance on the penultimate trading day of 2025. Silver rebounding after its biggest drop in more than 5 years yesterday as thin trading and leveraged traders drive heightened volatility. President Trump threatening to bring a lawsuit against Fed Chair Powell for, quote, incompetence, and tech companies racing to lock in deals ahead of the new year, with Meta agreeing to a rare purchase of an Asian tech company is coming in just 10 days, according to people familiar with the matter. Guy Johnson is beaming in to join me from London this morning. I'm beaming in from New York. John and Annmarie are both off. Guy, thank you so much for being with us. We are seeing a bit of a sputtering out of the Santa Claus rally at the same time that there's a lot of volatility in the metal space. How much are we seeing just the typical end of the year mush versus something that does give a signal into 2026?
Beaming in, does that imply I have to smile throughout this entire show?
100%, absolutely.
I'd like to do that anyway. Okay, I can do that. Look, I think there's two things to say here. One of which is that, yeah, year-end mush is probably a factor here. Thin markets are probably a factor here. That's why you're getting the choppiness. But the bigger picture, Lisa, is that the metals market is signaling something loud and clear. And that is that inflation is going to be a factor. Look at what is happening with copper. That is telling you that there's going to be an inflationary story into 2026. Look at what silver and gold are telling you right now. They're telling you that the dollar is going to be choppy as well. That's going to be a theme into 2026. Put those two things together. What does that mean for the Fed? Well, I think we're going to get some clues today when it comes to what is happening with these minutes. I think that's going to be really interesting.
Yeah, we are going to get the meeting minutes later today around 2 p.m. Eastern time. We do get, of course, the ADP labor market data coming out at 8:15. We will parse through that. Tomorrow we get jobless claims. Otherwise, it's a pretty thin week. To that point about what we are seeing in the metals market, we are seeing a bit of a rebound after yesterday seeing silver come off. See its biggest sell-off going back 5 years. You have seen the best year since 1979 for both gold and silver. You have seen the best year for copper going back to 2009 with a 40% gain. Today we build on some of those metals gains. We are seeing silver popping back 3.5%, gold 1.3%. In the broader equity space, futures, if you take a look at S&P futures, completely range-bound. NASDAQ as well after 2 straight days of losses on both indexes. Russell 2000 trying to get a little bit of a pop with the rotation trade really gaining steam, up about 0.1%. Meanwhile, in the bond space, it is notable how little volatility there has been in this space throughout the second half of this year, especially due to all the concerns that Guy was just laying out with respect to inflation, with respect to Fed independence. You are seeing a little bit of a sell-off in bond price, yields slightly higher still. We are seeing yields significantly lower than where we started, at least in the 2s and 10 space. The yield curve steepening remains prevalent. 30-year yields at 4.8%, almost exactly where they were to start the year. Coming up this hour, Kayla Sater of State Street Global Markets with stocks looking for direction to end the year. Wendy Schiller of Brown University as President Donald Trump and Israel Prime Minister Benjamin Netanyahu present a united front. And Constance Hunter of Economist Intelligence on why the United States economy faces a bumpy road ahead. We begin this hour with stocks a little change as traders await Fed minutes and the latest read on the labor market. Kayla Sater of State Street writing, although turbulence may remain elevated and concentration risk will remain high in 2026, we are still in a pro-equity and buy dips environment. Kayla joins us now for more. Kayla, thank you so much for being with us. Before we get into the equity outlook for 2026, I'm wondering what signal you're taking from a metals market that has been beset by volatility heading into year end.
Yeah. Hi, Lisa. Thanks so much for having me today. I do think this is kind of a case where it's not so much fundamentally driven. It's more so technically driven. We do kind of see these things at the end of the year as well. And I think if we take a step back and look at the broader picture, a lot of those fundamentals remain intact. A couple of minutes ago, you already highlighted just how great of a year a lot of these metals have had and how great of a year silver has had. And I don't think that what the past few days has shown us really signals a change in the underlying fundamentals there.
So let's take a step back. And to Guy's point, it's a really good one. How much does this signal something deeper in terms of the big returns for gold, for silver, for copper? Speaking to inflation, speaking to possible debasement of fiat currencies, is there a signal for 2026 that is market moving, that is potentially important for markets to listen to?
Yeah, I think there's two factors I'm paying attention to here. One is that inflation risk. We are not out of the woods when it comes to inflation. This is also something I'm looking to learn a bit more about in the Fed minutes today. It's just how concerned is the Fed about inflation? Because we did see, notes of dissent and things like that in the meeting in December. So, this could reflect concerns about inflation. The second point is that this has been an incredibly challenging year to diversify, and metals have been one source of diversification in portfolios. And given the overall environment, I would expect that to continue into 2026.
Kelly, good morning. It's Guy. Talk to me about where you see the dollar going in 2026, because this looks like one of the big pivot points for the market. If I'm a US investor, I've made, 17% in the S&P this year. If I'm a Eurozone investor, I've made just 3%. The dollar has been the biggest factor in my portfolio. Where does it go next?
Yeah, everyone cares where the dollar is going next. I think while there are fewer headwinds, there aren't a lot of tailwinds. So, for example, what I mean by that is when we look at our institutional investor behavior, our flow data signals that flows continue to sit around neutral. Now, 3 months ago, 2 months ago, they continued to show really strong selling. So really what we've seen is either selling or getting back to neutral. No real demand for buying. And I think we're not going to see appetite for dollar buying until we get through the first half of the year, because as we look towards cuts, as the Fed is expected to cut, that should continue to weigh on the dollar moving forward. So I still think there's challenges for dollar strength from here.
So you're implying that you think the Fed will be done by mid-year, that we'll be done with the cuts, and the next move, kind of from 6 months into this year, will be a hike. How do I think about, once I've got through the first 6 months, how significantly does the landscape change once we get to that point?
Yeah, that's a great question. I think moving forward, it's going to depend on a few things. One is, and the most important thing I really think, is inflation. We are not out of the woods when it comes to inflation. Inflation impacts everyone, but does not impact everyone equally. And when we think about upcoming stimulus in the economy, so things like One Big Beautiful Bill Act stimulus, all of that can feed the economy and let inflation continue to fester. And so I think that will be the most important factor in determining what's next for the Fed and really what's next for the dollar as well.
Kayla, does that mean that you don't really buy the rotation trade? That if you do think that inflation is resurgent, you think that the Fed isn't going to be in play as much as people think, and frankly, it's not going to fuel the outperformance of small caps and the rest of the 493?
I think you're spot on. I think it's going to be really challenging to see a sustained small cap rally if we start to see inflation, or if we continue to see inflation be relatively stubborn. There's a reason why we even see concentration within large cap stocks, is that concentration continues to sit with high quality companies, high quality parts of the market that are not debt dependent, that are not impacted as much by higher rates or elevated rates. And so I think that's going to continue moving forward. It's going to be really challenging for small caps from here.
It really raises this question about big cap tech and whether people have maybe had too much skepticism around that. And I wonder about your view, especially given some of the acquisitions that we've seen to end the year. We saw NVIDIA take a stake in Grok. It was a non-controlling stake in a certain way, or non-exclusive, I should say. So it is maybe going to fly under the regulatory radar this morning. Meta Platforms is agreeing to buy Manus, which is a Singapore-based AI-related company with its roots very much in China. How much does this just solidify the dominance of the Magnificent Seven?
I really think it all comes down to balance sheets. These are huge companies with diversified revenue streams, with huge cash flows. And so this gives them a lot of strength and power in the marketplace. One thing that's interesting is when we look at our data, so over 40 trillion assets under custody, looking specifically at institutional investors, what we find is that there's really just one overweight, and it's tech. You see a relatively mild overweight in communications. Everything else is neutral or underweight. And so I think that begs two questions. One, where do we go from here? Is there any room within tech where we can still add exposure? The answer to that is yes. Actually, when we look at positioning, one industry group where positioning is just neutral is software. So there still is room to add to software. The other point is that, are there any underweight sectors where we should start to see appetite increase just because they're too underweight? And one place that stands out in that regard is healthcare. So healthcare flows have started to increase. And I think that's more a reflection of exposure is just so underweight, and there are less headwinds now than there were before. I'm not saying we're extremely bullish on healthcare, but we are starting to see some signs of M&A and some signs of improvement that maybe look like there is just too much bad news there. But I think, moving forward into 2026, that big story is really going to continue to be AI and tech.
Kayla, how divorced from the consumer is the AI trade? Can the consumer still slow down and the AI trade carry on? Is this a twin-track economy? And you could almost, people talk about the K-shaped recovery, but is it a K-shaped market? And is it going to continue to be a K-shaped market?
Absolutely. I think you kind of see shades of this K-shaped economy, K-shaped market, in a lot of parts of the market and the economy. So on one hand, you have small cap versus large cap companies. That's likely to continue. We see a K-shaped economy in terms of the consumer. That's likely to continue. And one really important factor there is that there are structural changes that have occurred over the last 5 years that really exacerbate the K. So for example, housing. Housing has become so unaffordable for so many parts of the market or so many participants in the economy. So, for example, thinking about how during COVID, so many people refinanced their mortgages. And if you didn't have a home then, you really missed out on that opportunity. And now if you're still renting, you're still stuck in that environment where you're impacted by still relatively high interest rates. And so that's another example of a K. I think we see it, is, as you said, two tracks, I think. I think we'll continue to see that in terms of equities and in the real economy. And that really highlights why inflation is so structurally important. And I think that's why, bringing it back to the Fed, you're starting to see more members of the Fed be more vocal about those inflation concerns.
Kayla Seder of Straits Street, thank you so much for being with us. Kayla Seder, have a wonderful new year and see you in 2026. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hey, Lisa. President Donald Trump says that the U.S. struck a facility inside Venezuela in what would be a significant escalation in its campaign against alleged drug trafficking operations there. Trump's reference to an attack within Venezuela would mark the first time that the U.S. has announced a land strike in the country. And Russian President Vladimir Putin says that he'll revise his country's negotiating position after claiming that Ukrainian drones targeted his residence. Putin told President Trump in a call on Monday that Moscow intends to work closely with the US on peace efforts, but would reconsider a number of previously reached agreements. Ukrainian President Volodymyr Zelensky dismissed the Russian claims as a new lie. And President Donald Trump reiterating that he'd love to fire Fed Chair Jay Powell. Trump saying that he might still fire him for, quote, gross incompetence. Trump came close to seeking the Fed chair's ouster in July, but backed away after a negative reaction in financial markets. He said he'll probably announce his pick for Fed chair in January, and his preferred candidate hasn't changed. That's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. The easiest job in Washington, D.C. Up next, standing behind Israel.
We talked about Hamas, and they're going to be given a very short period of time to disarm. Speaking of Iran, I hope they're not trying to build up again, because if they are, we're going to have no choice but very quickly to eradicate that buildup.
Wendy Schiller of Brown University joins us next as we expand our view from the domestic to the international. This is Bloomberg Surveillance. Good morning. Sputtering out of the Santa Claus rally, at least for now. We had seen 2 straight days of losses, potentially building on that for a third straight day, with S&P futures lower by about 0.1%. You are seeing a bit of a sell-off in the bond space, but really it has been incredibly quiet, not very volatile. In the fixed income cohort, 4.11%. In the crude market, this has been a market. Crude futures have lost 17% so far this year, on pace for their worst year going back to the height of the pandemic back in 2020. We are seeing a bit of a firming up this morning, potentially because of geopolitics, potentially because OPEC Plus is likely to confirm an oil production pause. This being reported this morning. In the meantime, a real question around geopolitics under surveillance this morning, standing behind Israel.
I'm not concerned about anything that Israel's doing. Israel's lived up to the plan 100%. Speaking of Iran, I hope they're not trying to build up again, because if they are, we're going to have no choice but very quickly to eradicate that buildup. We talked about Hamas and we talked about disarmament, and they're going to be given a very short period of time to disarm. If they don't disarm, as they agreed to do, they agreed to it, and then they'll be held to pay for them.
Here's the latest. President Donald Trump meeting with Israeli Prime Minister Benjamin Netanyahu in Florida. The president issuing a new warning for Hamas in the push to move towards phase 2 of the peace plan for Gaza. Joining us now is someone who's been covering the story very closely, Bloomberg's Israel bureau chief, Ethan Bronner from Tel Aviv. Ethan, can you just give us a sense of what stood out from you the most from the meeting that we saw yesterday between the two leaders?
Well, I think the clips you played stood out most for me in the sense that they were such a full embrace of Israel by the president. It's not entirely clear that that's exactly what's happening behind the scenes, but as a public gesture, certainly that was the most important thing for Netanyahu. And, you know, it remains to be seen whether anything has been decided about how to move forward in Gaza, as well as in a whole range of other issues around Israel. They were very, very sparse with details publicly.
Ethan, there was also this extra question around Iran and whether this really did raise the specter of additional strikes by Israel or, frankly, by the U.S. on Iranian nuclear facilities. How much credence should we put into that?
That's another very difficult question. I would say that Israel believes that by talking aloud about the possible strike, it will spook Iran into reducing its activity, and therefore there won't be a need for it. But it doesn't mean that they won't ultimately do it. There's an enormous amount of talk in Israel about the need to take on Iran one more time because of its ballistic missile program and its rebuilding, apparently, of its nuclear program. So I do think it's a serious concern.
Ethan, in terms of the view of what is going on in Iran right now within Israel, there's a lot of domestic turbulence. There's a lot of concern within, I would have thought, the upper echelons of the Iranian authorities about what is happening on the streets. To what extent is Israel going to sit back and watch that? Or does it feel that that just encourages the need for further action? Is the regime seen as weak and getting weaker?
The regime is seen as weak and getting weaker, but it's been more than a decade that we've been hearing Israeli analysts and officials say this government in Iran can't last. The people want to rise up against it, and so on. So I think that, you know, like everyone, like in Venezuela, like in a sort of whole bunch of other places, it's very difficult to predict what kind of tipping point you reach, how to make sure it's going to actually happen. So I think that the Israelis are eager to see this happen. That's their ideal, rather than be any kind of military activity. And so it's a kind of, you know, they move on both fronts at the same time.
Ethan Bronner, thank you so much for being with us, and have a wonderful new year. Joining us now, Wendy Schiller of Brown University. Wendy, thank you so much for being with us. I want to start with the focus that we're seeing in Washington, D.C., with President Trump squarely looking at Israel, squarely looking at Ukraine and Russia, squarely looking at Venezuela. What do you make of the geopolitical focus to end the year in Washington, D.C.?
Well, Lisa, I think this is a continuation of President Trump's pivot to exercising U.S. power in selected ways. I mean, we see this with all presidents when things domestically look a little bit more complicated and maybe not going as well as they would like in terms of getting the economy to where I think the Trump administration would prefer it to be for consumers. Looking at how the United States can be relevant, how Trump can be relevant, and it's a flurry of activity, and he seems for the moment, genuinely committed not only to exercising U.S. power, but to achieving some breakthroughs, to getting some accomplishments, particularly with the Russia-Ukraine situation.
Given that, what do you make overnight of this accusation by Vladimir Putin that Ukraine targeted his home and saying that he was going to pause negotiations? How much do you think that really will derail that? And how much support do you see President Trump having with in his own party to side with Vladimir Putin?
Well, Lisa, this is a really important question going into 2026, as the Republicans, particularly in the House, have to really see, what their position is, literally with their own voters and their own constituents, and they're getting sort of hammered on a lot of fronts and spending lots of time worrying about overseas matters. Doesn't seem like a winning combination or platform for the Republicans, given affordability issues and, whatever the fallout is on not extending the Obamacare subsidies. So for Ukraine, I think the issue is that Putin doesn't seem to want to stop. He just seems not inclined, despite the losses, despite economic penalties that he's incurring. He doesn't want to stop. And I think that's becoming more apparent, and there'll have to be some ceding of territory. And this is a problem for Trump because, if Putin keeps moving the goal line, it's just almost impossible to get a solid deal.
Wendy, just picking up on that point, good morning, it's Guy. How much longer has the president got to get all this done before he needs to focus on the midterms, before he, as you say, that he needs to turn back to domestic matters?
Well, Guy, this is the interesting thing about a second-term president, particularly President Trump right now. The exercise of executive power, Trump has used it in ways we haven't seen before. But foreign policy has always been sort of a freer range for executives, and you can accomplish more without Congress. In foreign policy. He's got tariffs that we'll see what the Supreme Court says he can continue to do. But the point is, for Trump, the midterms don't actually matter all that much. He is in the model of a unitary executive. He's going to do what he wants to do until somebody stops him. And Congress so far has not exercised its power to stop him. So we may say, oh, he's a lame duck a year from now if they lose the House and maybe even the Senate. But in terms of the exercise of foreign policy, and even you can argue tariffs and possibly economic policy, he's going to keep going to use his executive power to the fullest.
But just in terms of his bandwidth, at the moment there seems to be a lot of bandwidth being used on foreign policy. He's got what's happening in the Middle East up in the air right now. He's got what's happening in Venezuela up in the air right now. He's got Ukraine up in the air right now. It's taking a lot of time. Does he have the time to do all of this, or does he actually now need to start focusing on those midterms? Just from a sort of political point of view, there's only 24 hours in the day. Can he spend as much time as he's doing at the moment on foreign policy and still see the Republicans having a decent showing come November?
Well, Guy, this is the really key question. For the Republicans, they're worried about his intervention in their primaries. So, when he decides to turn his attention to what they're doing, it matters to them because he can certainly, as we've seen in the fall, even in Tennessee, swing a primary at the last minute. So he doesn't think he has to pay attention 24 hours or really pivot that much. He has to intervene where it's going to be expedient for him. I think he would like to see these Obamacare subsidies extended. He may have different rhetoric, but he doesn't want that calamity on his hands. It's a distraction. But second, Trump likes a win. He likes a win he can take credit for. And increasingly, he's recognizing that's going to be much more difficult domestically than it is foreign policy. So I don't expect him to change his pivot anytime because he's got this political lever in the primaries on the Republicans, at least for the next 6 months, that he can swoop in, pressure point them, and get them to do what he thinks will be in his best interest, where he can claim a victory. So I'm not sure bandwidth is the right concept for Donald Trump. It's political victory. Where he sees it, he wants to take it.
Wendy Schiller of Brown University, thank you so much for being with us, and have a wonderful New Year celebration. Coming up, our conversation with Fed Governor Stephen Miron on his push for lower rates in the new year. Plus, Yahaira Anand with your morning movers. Newmont shares recovering this morning after major metal volatility. Those shares up 1.7% from New York. Futures looking for maybe a bounce back after 2 days of losses. This is Bloomberg Good Morning. This is supposed to be a wonderful time of year for stock market gains. We haven't seen it over the past couple of trading sessions. 2 straight days of losses today, building a little bit on that, at least when it comes to S&P and NASDAQ futures, taking a little bit of heat after a year of pretty phenomenal returns. We're already up about 17% so far this year. on the S&P, the Nasdaq up about 20%. Right now, you're down about 0.1% on both indexes. The Russell 2000 diverging, with futures up by about 0.1%, with a real focus on the Federal Reserve and how much they can cut next year. Right now, in the 2s, 10s, and 30s space, a mild sell-off, but ultimately the stability here is what's giving so many people confidence. The idea that two-year yield has been completely pegged at 3.5% or below that after earlier this year being around 4.3%. 30-year yields, though, still around 4.8%. The yield curve steepening continues, which raises questions about inflation and raises questions about what we're seeing in the metals trade. When you take a look at gold and silver rebounding after yesterday's sell-off, silver seeing its worst day yesterday going back 5 years. Copper on its longest winning streak going back to 2017 with the biggest annual gains since 2009. Gold and silver on track for their biggest annual gains since 1979. Building on that this morning, 3 hours away from the cash open. Here are your morning movers with Yahira Anna and Yahira.
Hi, Lisa. We start with Tesla. Those shares rebounding up 0.9% this morning after falling more than 3% yesterday on fresh concerns about its Cybertruck. That's because a key supplier slashed its battery contract with Tesla by about 99%, and those batteries were central to the Cybertruck. I will also say Tesla has given up earlier gains, and that's due to a report that Tesla published delivery estimates for the last quarter that were much lower than those estimates compiled by Bloomberg. Meanwhile, another stock rebounding this morning is the largest gold miner, and that is Newmont, up 1.6% this morning after falling nearly 6% yesterday, the most in 10 weeks. The pullback, of course, followed gold prices sliding yesterday amid all that volatility in the precious metals trade amid thin trading, though, with precious metals up again this morning. As you mentioned earlier, we are seeing miners like Newmont tracking those gains. And apparently, Labubu dolls were not on kids' Christmas wish list this morning. We saw shares of Pop Mart over in Hong Kong fall 4.5%, the most in 3 weeks, on reports that reseller demand is cooling. That's a big change from earlier this year when those dolls were all the craze, selling for hundreds of dollars in the secondary market. Lisa?
Who knew, Yahira, that $50 for a little doll that looked very strange would be something that would fall out of fashion? Just say. I know that I'm going to get a lot of hate mail. Meanwhile, on our radar this morning, President Donald Trump saying the U.S. has struck a facility inside Venezuela targeting alleged drug operations. This marks the first time the U.S. has admitted to a direct land strike on Venezuelan soil. Meanwhile, in the tech merger mania to end the year, Meta agreeing to buy Singapore-based startup Manus, marking a rare U.S. acquisition of an Asian tech company. The deal values the AI agent at more than $2 billion, with Meta intending to continue operating and selling the Manus service. Guy, this to me caught my attention, especially based on what we saw with NVIDIA's acquisition of a lot of the talent, at least, of Grok earlier this month.
Yeah, it felt like the Grok deal kind of moved the needle. What I'm surprised about this morning is that we're not seeing Meta's share price pre-market moving very much on the back of this. So is this a significant deal? I got Meta down by, 0.1% this morning pre-market, not moving much. So what does that tell us about market thoughts around this? Maybe not very much. Maybe nobody's at their desk. Maybe nobody cares. I think there are some interesting takeaways, though, one of which is that this is effectively a Chinese company. I know it's based out of Singapore, but in some ways it has very strong connections back into China. And I think, Lisa, that is going to be significant, from a kind of where Meta goes next story, but also how the Chinese are going to view American AI as well in terms of how they see their domestic base developing.
It's a great point, especially given that China's clamped down and said that they want more domestic production. Is this Meta's backdoor way of trying to get into China? Will China allow this deal to go through? It also raises this question of some of these cash-heavy companies in the tech space trying to preserve their dominance into 2026 as competition, as efficiency becomes more of the story. How much are these deals coming through to try to get under the radar in order to avoid regulatory scrutiny on both the U.S. side as well as on China?
Does it imply that Meta has some weaknesses somewhere? Does it imply that it needs to do more in this particular space, that it's better to go out and buy some talent maybe to maybe correct some of those issues? Or is it just, you know what, there's an opportunity there, let's take it, let's just keep spending the money? This is an insurance policy, isn't it? Basically, at the moment, the risk is greater in not doing anything than doing something. I.e., if somebody comes up from left field or right field and eats your lunch, that's too big a risk for these big tech companies to take at the moment. So the bigger risk is not doing anything, so therefore you do deals like this.
Yeah, if you've got that much cash burning a hole in your pocket, best to use it. Meanwhile, in other news that we're watching this morning, President Donald Trump doubling down on his desire to oust Fed Chair Jay Powell.
Will you ask Jay Powell to resign from the board entirely?
Be a favor to the nation. But he's come close. I mean, we're getting pretty close. I would fire him. I'd love to fire him, but we're so close, maybe I still might.
President Donald Trump adding his preferred candidate hasn't changed. Sticking with the Fed, our colleagues Annmarie Hordern and David Gura spoke with Trump-appointed Fed Governor Stephen Miron last week, who's planning to remain at the central bank beyond the expiration of his term until whoever President Donald Trump nominates as the next Fed chair is confirmed by the Senate. Take a listen to what he had to say.
You nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's the kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance?
So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
I want to ask you about the utility of the Miron dissent. So we had the Fed chair asked at that press conference about the increasing kind of fractured nature of the Fed committee. We've talked about quiet dissents as well. What are you achieving, or what's the reaction been to you dissenting as you have been kind of in the conversation among the committee?
Yeah, so look, I mean, there's not really any strategy here. I'm just transparent and say what I think and always have, and that gets me in a lot of trouble. And
but does it, or is it constructive? So when you dissent in the way in which you do, is it a constructive dissent? Do you find that others are willing to engage with you and your perspective on inflation, for instance?
Yeah, well, my perspective on inflation is look, in my first speech, I talked about inflation a little bit, but I mostly was focused on neutral. My speech last week, I really drew out a lot about my outlook for inflation that was sort of implicit in the first speech and sort of just cursorily treated, and I really drew that out. So my views on inflation haven't been out there fully fleshed out for the committee for so long, and now running into holiday season. But I have found that people are constructive. They want to discuss these things, and I think that's important. And look, one positive benefit of me potentially dissenting like this is that it introduces a wider variety of views. I think it's really, really important to avoid groupthink. I think if you fall into groupthink, you stop questioning where you could be wrong, and then it just becomes much easier to be a complacent consensus that is in error. I think we've seen that over and over this year, for example, on tariffs.
Let's talk potentially about tariffs. The president is pushing for this $2,000 tariff dividend. The Treasury Secretary is talking about these tax refunds start of 2026. Is there potential that more money in consumers' pockets could goose inflation?
Yeah, so there is potential for some of these factors to boost economic growth. With respect to sort of tax refunds, I think with respect to tariff refunds, I think we need to sort of wait and see what the policy looks like before getting into analyzing its consequences if there does end up being a policy. With respect to tax refunds that are a result of the already legislated tax bill, the One Big Beautiful Bill Act from last year, those are already baked into the forecast. And they will provide a little bit of demand stimulus, but there's so much other stuff going on as a result of policy in OPPB, in deregulation, in other things that are going on in economic policy that ultimately push out the supply side of the economy too. And my view is that if you push out the demand side while you're putting the brakes on the supply side, you get inflation. If you push out supply and demand at the same time, it doesn't really have an effect on prices.
But do you think it was a mistake that when we had under the Biden administration, the American Rescue Plan, Inflation Reduction Act, sending out checks to American consumers? Was that an error?
Well, it's not appropriate for a member of the Federal Reserve to be describing something as an error or not. But I do think that if you hit the gas on demand while you're hitting the brakes on supply at the same time, it will result in higher prices. That is an economic.
Would $2,000 checks do a similar reaction as we saw in by the other checks during the American Rescue Plan?
Well, it depends on what's happening on the supply. So two things matter. One is the state of the demand, state of aggregate demand outside of those checks. And if you go back several years, the economy was recovering on its own from COVID, right? COVID was not like, the financial crisis, which had lingering deleveraging effects for a decade plus, which meant that demand was persistently depressed. After COVID, we started getting vaccines, we started getting antivirals, places started opening back up, the economy started returning to normal on its own, and so demand was growing quite healthily, and jobs numbers were beating every month. And so throwing more economic support on top of that wound up sort of pushing an already expanding demand side to expand even further. Right now, you see the unemployment rate is tilting up on its own, right? So demand is in a very different place than it was in 2021, but so is supply, right? And I think that if you're taking policy steps that are going to push out supply, or supply is moving out for reasons other than policy, for instance, AI, which I find difficult to quantify, but a lot of people put a lot of faith in. If supply is moving out for whatever reasons, it can accommodate increasing demand. And so the effect on prices could be very different.
How are you thinking about the next meeting? Because it could potentially be your last. Do you plan on dissenting in favor of 50 basis point cut again?
Look, I plan on pushing for the policy that I think is appropriate at the time. I will say when I got to the Fed, we hadn't cut rates at all this year, and so it was very important for us to move rates down quickly. Since then, we've pushed rates down 3 times. 75 basis points of cuts to the policy rate. So the need for me to dissent for 50 becomes a little bit less as we come down. I haven't yet decided whether I'm going to push for 25 or 50 next meeting. I think it depends on a variety of factors. So I could see voting for 25, but I do think it's important that we continue steadily reducing the policy rate.
That was Fed Governor Stephen Miron speaking with my colleagues last week in a wonderful interview, laying out why Fed Governor Stephen Miron would like to cut rates aggressively and steadily. Right now, you have about a 16% chance of a Fed rate cut priced in for the January 28th meeting. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hi, Lisa. President Trump is threatening to strike Iran again if the country rebuilds its nuclear capabilities. Speaking as he met with Israeli Prime Minister Benjamin Netanyahu, Donald Trump expressed concern that Iran is seeking to revive its nuclear program. President Trump also said that he would support Israel in striking Iran if it continued with its ballistic missile program. And China is continuing to stage large-scale military drills around Taiwan. This morning, it fired dozens of rockets into waters near Taiwan. China's latest exercises come as President Xi Jinping ramps up military and diplomatic pressure on self-ruled Taiwan. President Trump trying to downplay China's actions, saying that they're a continuation of long-standing military exercises. And OPEC Plus is expected to confirm a planned output pause this weekend. Key members of the group will hold a monthly video conference on Sunday and review the decision that was first made in November. According to 3 delegates, the coalition will stand by its decision as global oil supply builds. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. And oil prices are just slightly higher this morning after one of the worst years going back to the pandemic. Up next, looking for economic clarity.
If you think about the economy the past few years, it has certainly been bifurcated, as has the market. It's hard to figure out what's going on in the near term.
Constance Hunter of Economist Intelligence joins us next to try to give her view of what's going on in the economy. From New York, this is Bloomberg Surveillance. Good morning. After a blockbuster year, failing to get that year-end Santa Claus pop that we normally get, right now you are seeing soggy futures down about 0.1% across the board after already seeing about 17% gain so far this year. Not to say it's been a bad year by any means. You are seeing a bit of a dip in bonds, prices down, yields up. You are seeing 4.11 on the 10-year. Silver rebounding after its worst one-day sell-off going back 5 years, up now 3.8%. Meanwhile, over in Europe, take a look at the DAX having its best year going back to to 2019, led by the defense sector, led by the bank sector, seeing Deutsche Bank up almost 100% this year. Rheinmetall in the defense space up 153%. We all talk about the dynamism of the United States, but Guy, frankly, this year we have seen an outperformance from European stocks, in particular in Germany, that we haven't seen in a very long time.
Absolutely. And this comes as we see a new government in Berlin that is going to push spending next year. European growth is really based on this idea that Berlin is going to deliver some sort of a fiscal push. We've already seen that coming through into the defense space. Defense stocks doing very well. But bank stocks, as you mentioned, also doing well. There's an expectation that we're going to see infrastructure spending coming through in Germany. Germany is absolutely pivotal to the European growth story next year. But I'll throw an extra one in for you as well, Lisa. Take a look at what the Spanish market has delivered so far this year, particularly if you're a dollar investor. If you're a dollar investor, the Spanish market has delivered 70% growth this year. You're up 70%. It's been an incredible performance. The Spanish economy has massively outperformed. This morning, you've seen quite strong inflation data coming through from Spain. Is that going to keep the ECB on hold into 2026?
Yeah, how much is this revenge of Southern Europe trying to take the helm in terms of economic growth? Meanwhile, focus very much on the United States, but you do get ADP jobs data coming out later today, as well as the meeting minutes from the previous Fed meeting. Jobless claims tomorrow, under surveillance this morning, looking for economic clarity.
If you think about the economy the past few years, it has certainly been bifurcated, as has the market. It's been narrow, both in the economy and the markets. No one knows exactly what's going to happen in the next 6 months. I think forecasting is always difficult, but there certainly is this odd kind of mix of policy that is out there. And I think you can see that through the Federal Reserve eyes. It's hard to figure out what's going on in the near term.
Here's the latest. Investors looking ahead to fresh data in the new year to get a clear read on the U.S. economy. Constance Hunter of Economist Intelligence writing, the U.S. will face a bumpy road. If 2026 were a fairy tale, it would be a mashup of Chicken Little and Ugly Duckling. To talk about this story, Constance joins us now. Do we have a sense of how clear the data has been so far? In other words, have we gotten any tell from the data in November and December that has been muddied by the government shutdown?
We've gotten very little data that's showed the impact of the government shutdown. The first piece of data would be the jobs data that we received earlier this month. And of course, that shows that the number of people who took the early retirement packages that came into effect in October. But of course, we know that the October collection for both jobs and CPI had flaws. So there's not a lot there. And honestly, I don't think that matters that much. What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026. So, of course, we have tailwinds in the fact that we have really strong consumption in the U.S. The Q3 GDP report was solid. If you had a smooth road ahead of you, that would absolutely be the ugly duckling, right? Where it turns into a swan and everybody thinks it's beautiful. But of course, there are potholes in the road, and that acorn that falls on Chicken Little's head may in fact mean that there are more acorns and the sky may fall, right? So we have the whole situation with trade. So not just that the IEEPA tariffs may be overturned, but the USMCA is up for renegotiation. And remember, these agreements that have been made are not trade deals. It takes decades to negotiate trade deals. Yeah. And so there's still a great deal of uncertainty there. And then, of course, as we've been talking about all morning, is the geopolitical uncertainty, whether we're talking about the Middle East, whether we're talking about China, Taiwan, which is now, of course, saber rattling to send a message to Japan, whether we talk about China making breakthroughs in the Arctic, whether we're talking about strikes against Venezuela. There's a lot of geopolitical uncertainty on the horizon as well.
So, Constance, this to me, there's the unknown unknown, right, which is the geopolitics. And then there's the known unknown, which is whether we see any kind of resurgence in the labor market or whether we see a resurgence in inflation. Which do you think is the bigger risk? Some sort of resurgence in inflation or a real substantial deterioration in the backdrop for the jobs market?
So, I don't know that they're mutually exclusive. And, you had the Stephen Mirren interview playing earlier, and he talked about It depends if you have a surge in demand, but if you also have a surge in supply. We don't think there's going to necessarily be a surge in supply. One of the really interesting things about the Q3 GDP report was all of the corporate profit information that was contained in there. So basically, a measure that's sort of similar to retained earnings rose 33%. Q3 over Q3, so year over year in the third quarter. Firms retained a huge amount of earnings, and we saw in the data that they didn't hire. They really slowed hiring. They absorbed some of the costs of the tariffs. They also front-loaded those tariffs, right, by importing at the end of last year and beginning of this year. And we really think that something has to give there, right? So firms don't keep 33% year-over-year retained earnings. They invest in CapEx, they pay them out in the form of dividends, or they hire more people. We think some combination of those things will happen in conjunction with them passing on higher prices. In addition, we're going to get the tax refunds from the One Big Beautiful Bill Act. So the first quarter GDP data and all of the data leading up to that release of the first quarter GDP is going to look fairly strong after coming off a pretty weak Q4 because of the government shutdown, right? So it's going to be a very confusing data landscape. And I think people have this idea that the tariffs are behind us and that the uncertainty from tariffs are behind us. That is not our view. We think that uncertainty is going to prevail next year. And again, one of those signals from that high retained earnings shows that firms are paralyzed. They're uncertain. What are they going to do with this profits? And I think that's the answer to that question is going to be the answer to the contour of the economy.
Okay, let's break that down a little bit. Constance, can the Fed continue to cut with inflation sounding as sticky as you make it sound?
Well, I suppose it could, depending upon the makeup of the FOMC. Is it likely to in the first half of the year? We don't think so. We think that there will continue to be dissents and that the Fed will hold rates steady for the first half of the year. On the other hand, if we see deterioration as a result of higher tariffs and if firms' margins compress in the second half of the year, then we could very well see 2 rate cuts in the second half of the year, especially as the pass-through from tariffs is likely to have dissipated by that time. But it's a big unknown when and how firms are going to pass on tariff rates. We also don't know if these tariff rates are the permanent tariff rates. We know that the administration likes to move things around as a matter of strategy, right? So there's a lot of uncertainty in that realm.
Constance Hunter of Economist Intelligence, thank you so much for being with us. And I wonder, Guy Johnson, from your vantage point over in Europe, if it's strange to see inflation where it is in the United States and discussion about how much the Federal Reserve can cut rates. And over at the ECB, you've got a growth rate of about 1% in the region. And they're saying, oh, no, we worried about getting inflation too high.
There's an op-ed, I think it's in the Journal today, talking about the idea that if the Fed had the single mandate that maybe the ECB has, would it be cutting rates? And I think that's a key question. This dual mandate, this confusing dual mandate, how well is it serving America right now? Is the labor market the priority, or is inflation in 2026 going to be where the focus should be? And actually, that may force the Fed to sit tight and sit out maybe 2026. I don't know. But that dual mandate certainly causing some confusion.
Well, yeah. And then there's a question about Europe. Should they include a dual mandate a little bit more to try to get growth up? Coming up next, we're going to be talking about both sides of this as well as the economic outlook forward. Mark Cabana of Bank of America, Bloomberg's Kate Sullivan, and Craig Trudell and Laura Mayfield of Fort Washington Investment Advisors. From New York and from London, you're watching Bloomberg Surveillance. Good morning.
There's going to be a meaningful correction at some point over the course of 2026.
We want to make sure we're managing risk well next year.
What the market is saying is that earnings matter more than ever right now.
It is encouraging that we are seeing broader participation in the rally.
Investors need to be ready for surprises and the unexpected.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Precious metals in focus after delivering their best annual gains since 1979, with silver and gold on the upswing in volatile markets. A focus on big tech as Meta follows Nvidia, making acquisitions in the final days of 2025 to solidify their AI dominance. And President Trump keeping his focus on the Federal Reserve with more harsh words for Chair Powell in the twilight of his term. Guy Johnson joining from London. I'm here in New York. John and Anne-Marie are both off for the holiday. A very quiet period, Guy. Most people go on vacation, are enjoying their families. A lot of people, though, wondering when they tune back into the Bloomberg terminal why there is so much volatility in markets, particularly tied to metals, and whether there's a tell here that's important.
The metals market's been the story of 2025 in so many ways. What you've seen in gold, the debasement trade, what then happened in silver, what's going on copper is absolutely important right now. We spent the last hour questioning our guests about what their inflation outlook is going to be. Dr. Copper is telling you maybe what that inflation outlook is going to be, and it's likely to be sticky. The metals trade is telling you that maybe the dollar goes down in 2026 and that inflation remains a problem, Lisa.
Yeah, this is going to be something that's going to be a theme, especially as people increasingly point to this question of U.S. exceptionalism and whether we really saw some sort of waning in that in terms of the underperformance of U.S. equity markets in 2025. In the meantime, coming up this week, we do have a number of economic indicators. It is a week, a sort of light week for all of these types of things, but we do get ADP labor market statistics later this morning. Fed meeting minutes at 2 p.m. this afternoon, Eastern time. On Wednesday, we get jobless claims. And then, of course, on Thursday, markets are closed for New Year's Day. Right now, not seeing the Santa Claus rally. We just had 2 days of declines. We're building on that, although almost flat now on S&P futures. NASDAQ futures the same. And Russell 2000, the outperformance. A question of how much the rotation trade can really gain steam, especially without participation in 2s, 10s, and 30s. In the bond space, you are not seeing that sort of a rip-roaring rally that you saw during parts of this year, although still a very quiet finish to the year. We are seeing 3.5%, 3.46% on the 2-year and 4.8% on the 30-year, the yield curve steepening. And then, as we were just talking about in the metal space, you are seeing silver and gold rebound. Yesterday, we saw the biggest one-day sell-off in silver going back to 2020. Nonetheless, just to point out, silver and gold have had their best years going back to 1979. Copper on track for its best year going back to 2017. Coming up this hour, Mark Cabana of Bank of America as investors eye the latest Fed minutes. Bloomberg's Kate Sullivan as the U.S. ramps up attacks on Venezuela. And Laura Mayfield of Fort Washington Investment Advisors as AI hyperscalers push debt issuance to record levels. We begin this hour with stocks hovering near all-time highs, trying to reprise some sort of rally as President Trump renews his attacks on Federal Reserve Chair Jay Powell.
Will you ask Jay Powell to resign from the board entirely?
He'd be a favor to the nation. But he's come close. I mean, we're getting pretty close. I would fire him. I'd love to fire him, but we're so close, you know, maybe I still might.
The president saying he has a preferred Fed chair candidate, but is in no hurry to make an announcement. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, it's the story that won't go away. The whodunit that has to do with the Fed chair and whether they're going to announce the new candidate anytime soon. Was there any new daylight shed on this issue from President Trump's comments yesterday?
Yeah. Hey, Lisa. Good morning. Well, when it comes to President Trump talking about his favorite to lead the Federal Reserve, he did say that he will announce him when the time is right, in his own words, though went on to indicate that we can't expect a decision within the next month. It comes as the White House is continuing interviews for the position. Bloomberg News has confirmed that President Trump will meet privately at Mar-a-Lago with BlackRock's Rick Rieder. As we zero in on the top 4 candidates. Our reporting indicates that includes Rieder alongside current Fed Governor Christopher Waller, who interviewed with President Trump earlier this month, and then, of course, former Fed Governor Kevin Warsh and the NEC Director Kevin Hassett. Now, President Trump has sometimes made contradictory remarks when it comes to his process in finding the next Fed chair, but the one consistency has been his criticism of the current Fed chair. And as you heard, he renewed his attacks against Jerome Powell yesterday, going as far as to re-threaten a potential potential lawsuit over the Fed's renovations of its headquarters here in Washington, and then really turning to tout his own economic policies. And he had this particular emphasis when it comes to growth. Now, the shutdown is expected to weigh on fourth quarter GDP, but economists do forecast a modest rebound in 2026. And I bring that up because the backdrop to today in this conversation is that we are going to get those minutes from the December meeting. And while it didn't appear that policymakers were expecting such a burst in the third quarter GDP number released after the December meeting, enough of them did revise up their growth forecast for next year. So, Lisa, as we're wading through the minutes, we're going to be looking for clues as to what's informing their outlook regarding the AI boom, expected stimulus from the one big beautiful bill, despite what has been a weakening in consumer sentiment. And that is really the underlying theme to this entire conversation, because that is the push and pull that this White House has been trying to navigate.
Yeah, and what is the Fed's reaction function? Tyler Kendall, thank you so much. Well framed, as always. Mark Cabana of Bank of America joins us now for more. Mark, I am curious from your vantage point, and good morning, how relevant you find all these comments, jawboning the Federal Reserve. What's your takeaway when you hear President Trump continue to talk and really bash Fed Chair Jerome Powell?
Well, good morning. Happy New Year. Hope you had a nice holiday with your family.
You too.
So our take is that we've heard this so many times before. And what we're really interested in is who is the individual going to be? What is their preference on policy broadly? And then will there be any further turnover or change within the Federal Reserve? It is a committee. We do know that it takes a number of individuals to move the needle on Fed policy and impact interest rates. And we're really trying to figure out who that's going to be, what their preferences are, and how does the committee composition change. So we, just like the rest of the market, are waiting for guidance on this. And we do think it'll come relatively soon. As you know, at the end of January, that's when Stephen Moran's term ends. He can stay on, but we do expect that as his term comes to a close, we will get the nomination for the next Fed chair. If it is an outsider, i.e. not Bowman or Waller, then they're going to likely want to be confirmed by the end of January. And then they will join the committee, serving in a bit of a shadow Fed chair capacity. And we're going to learn a little bit more about what their preferences are on rates and what that means for the general outlook for policy in the near future.
Mark, good morning. It's Guy. Is it important if Powell, when he steps down, leaves entirely or continues to retain a seat? Is that going to be important, and how pivotal could it be?
Yeah, it does matter a lot because it influences that composition of the committee. As you know, it takes 7 voters for any action at the Fed. And if Powell chooses to stay, which would be historically unprecedented, then it will mean that there's probably less willingness to cut rates aggressively. If he leaves, it'll give the Trump administration one more seat in which they can potentially remake that committee and potentially then advocate for lower rates. History would suggest that Powell will step down, but this is indeed his decision. And if he goes, it's just going to mean one more vote for potentially lower rates and a preference to likely overweight the unemployment side of the Fed's mandate versus the inflation side of the Fed's mandate. And look, when we think about the outlook for interest rates over the course of 2026, we do think that the Fed composition is extremely important. And that's one of the reasons that we do believe that the distribution of risks to the rate outlook is skewed to the downside. We do believe it means likely lower rates, steeper curve, lower real rates, higher inflation, lower volatility, which, by the way, I do think is quite a story for the end of 2025 that doesn't get a ton of airplay. Yeah. But that low vol environment is so important for U.S. rates, for U.S. fixed income more broadly, for elements of the dollar, elements of the commodities trade and the gold trade that you were talking about before. And that Fed composition does very much influence the outlook for rates and the outlook for vol. And we do think that that's going to be a very, very relevant theme as we start 2026.
Mark, I was thinking about this as well this morning. The move index that you guys create has been tracking lower throughout the back half of the year. What I don't get is, if I have a more volatile Fed, if I have a more volatile FOMC, why doesn't that translate into a more volatile market? Can you explain that?
Yeah, so the way that we think about it is that there may be disagreement within the Fed, but as you get the shift in composition at the Fed, what it does is it just narrows the range of potential rate outcomes. And as you increasingly staff the Fed with individuals that are going to be advocating for at worst rates on hold or potentially lower rates, what it does is it just further trims the potential that rates will be moving higher. And as you narrow the range of outcomes, that does mean that vol should be moving lower. And lower rate vol does touch a wide set of financial markets. And we do think that that's going to be a key and persistent theme over the first half of 2026. As you get later into 2026, the range of outcomes widens. There's midterms to consider, and just natural uncertainty that rises with time. But in the first half of 2026, we do think that vol will remain low, and that's going to keep financial conditions quite easy, and that's going to be generally supportive for the growth backdrop. As long as you have a Fed that's not hiking, then you've got really only either stable rates or lower rates to seriously consider.
I can think of all the metals traders out there listening to this conversation and saying, but gold, it's telling us something. What is it telling us? The idea that copper has been on a tear, that silver has been on a tear, that you have seen a depreciation of the dollar and, frankly, an underperformance of U.S. assets in relation to some of these precious metals. Do you think that this is telling you of some kind of inflationary impulse that will come out in what we're seeing with respect to steeper yield curves? And even if it's not volatility, that will grind wider throughout the year and potentially put a cap on some of that risk appetite?
Well, we do. I mean, we think it's going to be a dynamic that is characterized by very strong growth, by inflation, albeit sticky, that generally gets overlooked in favor of driving a continued strong labor market and keeps vol low. All of those things will be very, very supportive of growth. And I do think that metals are very consistent with that right now. Dr. Copper, as you mentioned, certainly is telling me that growth is going to be very strong globally over the course of 2026. What we see in gold and silver, there's no doubt some technicals that are at play there that drove the very, very sharp spike in silver and then slight rebound or slight decline that we've seen over the last few days. But I do think that there is a bit of a debasement concern there, i.e. central banks, especially the Fed, that may be a little bit more dismissive of inflation than they have traditionally been. And that should mean weaker dollar, should mean lower rates, and that, again, should be tailwinds broadly for financial conditions. All of this points to a better growth backdrop. All of this points to a very supportive backdrop for activity and continued easing in financial conditions over the course of 2026, we think. The biggest risk to all of that is inflation. The biggest risk is that the Fed has to consider raising rates at some point over the course of next year. We put very low probability on that right now. The market does as well, it seems, but that would be the biggest shift that could potentially throw a wrench into the low vol and easy financial conditions and high overall base metal price conditions that we are currently seeing today.
So next year, we're going to see the one big beautiful bill and some of the tax cuts that people are already expecting. We could potentially see $2,000 checks sent out to different individuals. There is a concern about budget deficits, especially if IEPA is overturned. What happened to bond vigilantes? Are they asleep? Do they not exist? Is that going to be a story that's going to come back in 2026?
It could. Right now, you're right, Lisa, that the market is very unconcerned with that. If you look at asset swap spreads, in addition to vol, they tell you that the bond vigilante concerns are very, very low. We think that they remain at bay. And a big part of that is due to changes that we are seeing with U.S. Treasury issuance. Changes very technically that the Fed is pursuing in terms of these reserve management purchases and the addition of liquidity that we're seeing to really better anchor repo rates in the Fed's target range, and potentially changes that are happening on the regulatory front for banks and as well as dealers. There's also important market structure changes, very technical in nature that I won't go into in great depth, but you're going to get cross-margining benefits. You're going to get something called collateral in lieu. All of these things we do think will be supportive of increasing dealer intermediation capacity. And what that will mean is that you're just going to have a better environment for risk-taking and fixed income, especially in the Treasury market. And that should mean that you don't get these type of bond vigilante concerns in a big way. It helps a lot that Treasury is really only increasing issuance at the very front end of the curve, where duration risk is very, very minimal. And what that should mean is that that will limit those concerns of bond vigilantes from really taking off, despite all of the headwinds that you just mentioned.
Mark, can I come at that question from a different angle and talk a little bit about market structure? There is an increasing... we're seeing the Treasury market being held increasingly by private foreign holders, right? And the data, you look at the TIX data, that supports that. When you get shifts in sentiment, does that mean that you're going to see those shifts in sentiment being amplified because traditional reserve managers held a kind of more stable position, private owners don't, and therefore are likely to change opinions and more dramatically once the ground shifts under them? If we do see some sort of a change in 2026, if inflation is a problem, does that mean the magnitude of that shift is going to be even greater?
It certainly could. Now, when we think about ownership of treasuries, you rightly highlight that private foreign demand has been remarkably resilient, despite all of the concerns that were evidenced over the course of 2025. But when we think about private foreign demand, I really think of it coming through two different ways. One, through, let's say, the more traditional asset manager or real money investor, and then the second through a highly levered, let's say, relative value hedge fund type trade. In the real money sector, we think that money should be pretty stable, that should be pretty sticky. And that's largely because when we talk to global investors, what they frequently reiterate is just that there's not a lot of great alternatives in the global fixed income markets away from US dollar fixed income. And if you want relatively risk-free assets like you get in the Treasury market, the size of the market, the depth of the market is really unparalleled. And so many investors feel like, well, they might not want to be in dollars, but they don't have many other good alternatives, so they have to remain there. Now, where we do get a little bit more concerned is when we think about the relative value and highly levered, let's say, hedge fund positions. Those investors are worldwide, but there's a high concentration of those investors, especially in the UK. And what we do worry about there is anything that could potentially trigger elevated volatility and subsequent deleveraging. That could come from the repo market. It could come from a very volatile macro environment. And we do worry about the concentration of ownership there as potentially exacerbating volatility if it were to rise meaningfully. Now, we don't think that'll be the case in the first half of 2026. We do think that low vol, inflation that's moving generally lower, a Fed that's at worst on hold, if not cutting, will characterize the market in the first half of 2026. But that concentration is indeed a risk. That these market structure and regulatory changes should help limit that risk in the near term.
Mark Cabana of Bank of America, wonderful to get your thoughts. Have a wonderful new year. Really great to see you. Of Bank of America, hopefully it will be joining us in 2026. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Chinese stocks are on track for their best year since 2017, with the MSCI China Index up nearly 30% so far this year. It's even on pace to overtake the S&P 500 by its widest margin in 8 years. The materials sector has led the rally, mirroring a worldwide trend of record-breaking commodity prices, while China's utilities and property sectors underperformed, barely seeing any gains since the year began. Elsewhere, the controversy over President Donald Trump's name being added to the Kennedy Arts Center is continuing. The New York Times reporting a veteran jazz ensemble and a New York dance company have cancelled events for New Year's Eve. This follows the cancellation of an annual Christmas Eve jazz concert. The Times reporting that the Kennedy Center chairman says the artists cancelling shows were, quote, far-left political activists. And a winter storm knocked out power to hundreds of thousands in the northern United States. According to the Weather Prediction Center, a bomb cyclone hit the Great Lakes region, leading to intense winds and rapidly falling temperatures. The center saying power outages were caused by strong winds and freezing power lines. And that should be my brief. Lisa.
Thank you so much, Lizzie. Up next, escalating tensions with Venezuela.
There was a major explosion in the dock area where they load the boats up with drugs. They load the boats up with drugs. So we hit all the boats, and now we hit the area.
Bloomberg's Kate Sullivan joins us next, as this might be the first time the U.S. has hit on land in Venezuela. From New York, this is Bloomberg Surveillance. Good morning. supposed to be a very good time for equity market performance. Over the last two trading sessions hasn't been the case. However, this morning, as we get closer to the open, erasing losses from earlier in the session, now basically flat on S&P futures. You are seeing a bit of a sell-off pick up speed in the bond space. 10-year yields up 2 basis points to 4.13% in crude. Watch this space. Prices up, futures up about 0.5% after reports that OPEC Plus is considering maintaining some of their output curbs, not necessarily increasing output at the same pace due to the glut that a lot of people are pointing to. Meanwhile, a focus on the geopolitics of the morning under surveillance this morning, escalating tensions with Venezuela.
There was a major explosion in the dock area where they load the boats up with drugs. They load the boats up with drugs, so we hit all the boats, and now we hit the area. It's the implementation area. That's where they implement, and that is no longer around.
Here's the latest. President Trump telling reporters that the U.S. hit a facility in Venezuela, marking the first known land strike since the White House began its pressure campaign against President Maduro's government. Joining us now is Bloomberg's Kate Sullivan. Kate, thank you so much for being with us. What do we know about this latest strike?
Well, I think it's notable just how few details we have about this strike, beyond what the president confirmed himself or disclosed himself to reporters. He talked about this first in a radio interview and then was asked several questions about it yesterday when he was meeting with Prime Minister Netanyahu. And he really didn't go beyond, what you heard there in that clip. But it's extremely notable given, this appears to be the first disclosed or known land strike on Venezuela. This is something that the president has been previewing for quite some time now, so it doesn't come as a complete surprise. But I think there were questions about whether this was just going to be posturing, when the president was talking about carrying out these land strikes on Venezuela. It's, of course, part of a larger pressure campaign on Maduro, on the Maduro regime in Venezuela. The United States has been really significantly building up its naval capabilities in the region. It's been seizing oil tankers and then, of course, carrying out those strikes on boats that they say are smuggling drugs. More than 100 people have been killed in those strikes. And there are a lot of questions about the legality of those strikes. And critics say there is no legal basis. So given the developments and what we heard from the president yesterday, I would expect a lot more pressure on the administration, on the White House, to really just disclose more details about who exactly carried out the strike and just more details around that operation and what the goals were.
Okay, good morning. It's Guy. How much further could the White House go without having to go to Congress and get some sort of a green light?
Yeah, I think that is the big question, right? I think a lot of lawmakers have been putting a lot of pressure on the White House to really just keep them more in the loop. Again, there are a lot of questions about the legality here. The White House has really staunchly defended its actions. It says that it is combating drug trafficking and has really, just said that they have a lot of authority to do what they're doing here. So it's a great question. I know a lot of people are very curious to see just how far this goes, whether there are more land strikes that take place. It seems to be, that there will be more strikes on there's no letting up of these strikes on these boats that they say are smuggling drugs. And so it's a great question how far this is going to go and what is actually going to happen to Maduro and his regime.
Kate Sullivan, thank you so much, as always, for joining us and for that insight. Coming up, Bloomberg's Christina Aquino, as silver and gold find their footing after yesterday's sell-off. A massive year for the precious metals so far. Plus, Yahira Anand with your morning movers. Tesla shares in focus after lowering expectations. This is Bloomberg Surveillance. The Santa Claus rally begins December 24th and ends on January 5th. And 80% of the time, going back to the 1950s, you have seen a gain. Right now, not necessarily keeping up with that promise. You are seeing essentially flat flat futures on S&P and NASDAQ. And Russell, you are seeing that lift. A question about the rotation up 0.2%. You are seeing just a touch of a sell-off in the bond space. 2s, 10s, and 30s yields higher, but just marginally. Not a lot of action ahead of a slew of data to end the year. The 30-year most notable, up now 3 basis points to 4.83% as people wonder about inflation. Take a look at what could be fueling that, which is in the metal space. What you see in gold, silver, and copper. Gains across the board after a banner year for all of these metals. Copper is having its best year going back to 2017, up some 40%. Longest winning streak going back, or the best winning streaks going back to 2009. The longest winning streak going back to 2017. Gold and silver, their best years going back to 1979. 2 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We are seeing Tesla shares in the green this morning after falling more than 3% yesterday on news that a key supplier cut its battery contract with the EV maker. Still, the stock has given up its earlier gains as investors look at new delivery estimates posted on its website, which show deliveries for this quarter are lower than the numbers that Bloomberg had compiled. Meanwhile, quantum stocks have had quite the ride this year, and it's no different in these last trading sessions of the year. They sold off last week, but are all in the green this morning after a roller coaster ride. Remember, back in January, Jensen Huang warned that useful quantum computers were decades away, then surging in June when he changed his mind. And then you had reports that the Trump administration was considering taking equity stakes in these companies. So one to watch definitely in 2026. And we end on Applied Digital. This is a data center cloud company. Shares are up 1 3/4% on news that it's spinning out its cloud computing unit and merging it with another company in an effort to streamline its AI critical businesses. Investors have loved the stock. Shares are up 200%, more than 200% year to date. Lisa.
Thank you so much, Yahira. On our radar this morning, Ukraine denying an alleged attack on a residence of Russian leader Vladimir Putin. President Trump addressing the allegation yesterday.
It's one thing to be offensive because they're offensive. It's another thing to attack his house. It's not the right time to do any of that, and can't do it. And I learned about it from President Putin today. I was very angry about it.
The Russian foreign minister alleges that Kyiv launched a drone attack on Putin's state residence on December 29th, offering no evidence to support the accusation. Meanwhile, President Trump teasing that he has a preferred candidate for the next Federal Reserve chair, but is in no hurry to make an announcement.
You've said that you have one favorite, but you're also doing interviews.
Still do. Hasn't changed. Yeah, I'll announce him at the right time. There's plenty of time.
The president also saying he may bring a lawsuit against current Fed Chair Jay Powell for gross incompetence over renovation costs at the Federal Reserve. Meanwhile, China is reportedly requiring chip makers to use at least 50% domestically made equipment for adding new capacity. According to a Reuters exclusive, the rule is not public, but chip makers are being told they must prove that at least half of their equipment will be Chinese made, and comes after a lot of speculation about how much U.S. chip makers are really going to be allowed into China as a very nationalistic push happens there. Guy, how important is it to really see things like this in addition to Meta's recent acquisition of Manus? This question of if you sell it, will they come? If the U.S. can sell some of these chips, will China buy them?
The answer appears to be, well, probably no at this point, doesn't it? It's really interesting that NVIDIA keeps trying to push for the idea that maybe it should be able to sell chips into China, trying to get the White House maybe to give it the green light, and it appears to be making progress on that front. But the Chinese are the problem here. It's fascinating. Jensen Huang's biggest problem is not the White House, it's what's happening in Beijing. The Chinese clearly feel that they have to catch up. They clearly feel that this is an area that they have to make progress in. It's just interesting in terms of the imbalances that exist within this space. The US has the chips, but maybe doesn't have the electrons, the power. The Chinese have the power, but don't necessarily have the chips. Kind of, how does that even out, and what will that race look like in 2026? The Chinese desperate to catch up on the chip front. That feels like it could be something that you could do faster than maybe catching up on the electricity front, which maybe gives the Chinese the advantage at this point?
Well, right now, the advantage really goes to metals because that has been the one area as everyone tries to build out the physical world that continues to get bid. Silver, meanwhile, recovering some losses after its biggest one-day drop in more than 5 years. Supply shortages keeping the metal on track for a monthly gain of close to a third. Bloomberg's Christine Aquino joins us now for more. Christine, before we get into the bigger trends, just can you talk a little bit about how much leverage, how much sort of fast money is behind some of the pretty violent moves that we've seen over the past couple of weeks?
Well, Lisa, the short answer is a lot. There's been a lot of speculation in this market, especially as investors started to observe that silver very much extending the gains that initially were rooted in gold, right? And, initially this was kind of a higher beta play, right? Silver usually seen as a higher beta version of gold. And so when gold started rallying, investors started wondering, where else can I put this momentum behind? And silver became the focal point. But of course, very interesting because silver, very much a precious metal, but it also has very important industrial functions, right? And so we've really seen that speculation ramp up. We've seen, exchanges now having to raise their margins. China's silver play fund, pure silver play fund, turning away new investors. These are just some examples of just measures that authorities and bodies have taken to really curb the speculation that has ramped up so much in the last month or so as silver really turned into very much from a precious metal play, a haven play, to a speculative play. And that's what we're seeing now.
Christine, once silver takes over, once the kind of the gold-silver ratio shifts, what does that tell us? What does history tell us about how much longer the precious metal rally has to run?
Well, Guy, it's very interesting because it really is just boiling down to supply, right? I think that ratio very much a signal for some investors. And again, what we've seen, gold rallying and then silver taking that rally and then extending it so much more. And that is very much a result of that shift in the ratio that you're mentioning, the gold-silver ratio. It hasn't really held above 100 to 1 for very long. And so that, I think, signaled the shift for a lot of investors. But how much longer it can run really just boils down to how much silver is there left to buy. And at the moment, there is a critical shortage of the metal. And this is why we're seeing a lot of these restrictions, a lot of these curbs. And that's not necessarily going to alleviate heading into 2026. We have potential tighter exports coming from China. China's not a major exporter of silver, but that just really further shrinks the pool of available silver to buy. And then, of course, a lot of the world's silver actually still stuck in U.S. warehouses as investors await the result of the U.S. Section 232 probe into critical minerals. And so not necessarily a lot of clarity on that front. And so really, it's just going to be a question of supply when it comes to how much further this rally goes. If there's not much clarity on supply alleviating anytime soon, then, this market is going to be very, very tight for the foreseeable future.
Bloomberg's Christine Aquino, wonderful reporting. Thank you so much for being with us. Let's turn to autos, another once demand supply, at least for some of these metals. Tesla lowering expectations for its annual vehicle sales. The EV maker posting a compilation of analyst estimates below averages gathered by Bloomberg. Craig Trudell joins us now. Wonderful reporting, Craig. Just can you lay out how much of a disappointment some of these projections really are for Tesla?
Yeah, I think, just starting off with the fourth quarter, you have this company compiled consensus, as they call it, round numbers looking around 423,000 vehicles. That's a pretty substantial difference between, what Bloomberg's average estimates are. That's around 445,000. So it's about a 22,000 vehicle shortfall. I think, going forward, what's interesting is also not a whole lot of optimism about the outlook for 2026. And we've seen consensus come down for next year pretty substantially as well over the last couple of years, where, the expectations for the company was, on this time frame to be selling, 3.5 million vehicles. And we're now sort of seeing, those estimates come down to, yes, higher than what we will probably end up seeing for 2025, but not substantially so, and sort of a continued rut for this company that was once growing really like gangbusters year after year.
Craig, does it matter? honestly, does it matter? If you're a shareholder in Tesla, does this matter?
Lately the answer to that has been no. And I think what's really fascinating here is that you seem to have this, coalescing consensus around two ideas that seem to be very much in conflict with one another. On one hand, an expectation that this company is on the verge of, quote unquote, solving self-driving and, rendering its vehicles capable of turning into robo-taxis. And yet, on the other hand, not a substantial change in the sort of sales outlook for this company. You would think that if there's so much optimism about this company's autonomy prospects, that you would see that sort of translate into, oh my gosh, demand is going to shoot up, and yet we're not seeing those move in unison with one another.
Craig, do we have a sense of why Tesla has seen its fortunes kind of shift when it comes to the actual number of cars that it expects to sell? Is it because of some of the political issues around Elon Musk? Is it because of China demand and competition domestically there? Or is it because of the subsidies in the United States, the lack of them, and the fact that people are moving away from electric vehicles here?
Yeah, I would say all the above to some degree. I think particularly over here in Europe, you've seen continued, substantial weakness. I think a lot of that has to do with Elon Musk being something of a turnoff. I think it also has to do with, rising competition with, the sort of quote unquote incumbents, and also the Chinese manufacturers really getting some traction across Europe. In China, you see the domestic players really kind of taking that market and running with it, whereas, Tesla at best has been sort of stable. And in the U.S., you have, to Tesla's credit, they had a great third quarter, in part because of the rush to take advantage of those tax credits you mentioned. But we now are in a paradigm where those have, fallen by the wayside. The Trump administration not only has taken those away, but taken away, fuel economy regulations and emissions rules. So, this is an industry that is kind of, turning back the clock and going back to selling as many big pickups and full-size SUVs as they possibly can. And they're doing that without, sort of any abandon. They're not having to worry about buying regulatory credits from Tesla. So you have not only headwinds for the company from a vehicle sales perspective, but also a part of its business that it's counted on for substantial revenue for many years.
Craig Trudell, thank you so much for joining us and for all the reporting throughout this year. Craig joining us there of Bloomberg News. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Copper's heading for a 10th day of gains and its longest winning streak since 2017. The surge is adding to the metal's biggest annual climb since 2009. Bulls say tariffs, a weaker dollar and supply issues are all helping to drive up prices for the commodity. Elsewhere, Meta is agreeing to buy Manus, a Singapore-based artificial intelligence agent, to build a business around its AI investment. The deal values Manus at more than $2 billion and marks a rare U.S. acquisition of an Asian tech company. Meta's intending to continue operating and selling the Manus service. And shares of PopMart falling the most in 3 weeks on falling demand for Labubu dolls. The sell-off stemming from reports that scalpers have paused buying the toys. PopMart had staged a dramatic market rally, but has since cooled on weaker than expected holiday season sales and doubts about the company's brand. I'm sure none of those were in your stocking this Christmas, Lisa. That should be my brief.
Thank you so much, Lizzie. I have to admit, not so much. Maybe it's boys versus girls, but I don't know. Nonetheless, up next, hiding out in high quality.
You don't have to be cute with these markets. You can kind of just hide out in the high quality space for now and then wait for these opportunities to develop out the credit risk spectrum.
Laura Mayfield of Fort Washington Investment Advisors joins next. This is Bloomberg Surveillance. Good morning. Trying to break a streak of 2 days of losses, we are seeing futures churning ahead of the open in this penultimate day of 2025, basically flat on the S&P and NASDAQ. Russell 2000 doing better, outperforming with 0.2% gain, with a question about the Federal Reserve, with a question about inflation, with a question about accommodation. 2s, 10s, and 30s not really doing that much. On the front end, we've been pegged to that 3.46% level. We are just a basis point this morning. On the long end, though, the sell-off gaining steam this morning. 30-year yields up 3 basis points to 4.82%. The real story, the fireworks, has been in the metal space. We have seen copper, we have seen silver, we have seen gold with an incredible outperformance so far this year. A big bout of volatility yesterday, particularly with silver selling off the most in 5 years. Today, clawing that back up more than 5%. Silver and gold posting their best years going back to 1979. A question about the year ahead for fixed income under surveillance this morning, hiding out in high quality.
We think that, some of those deals, those AI data center deals, they've come out. We haven't invested in them because you just don't get the upside like you do on the equity side of things. We're bond investors. We're trying to get back par on our investments. And if you're getting these deals coming at 200 or 225, it doesn't make as much sense. There's still plenty of other places to find value, and spreads are still at the kind of wider end of the last decade there. So you don't have to be cute with these markets. You can kind of just hide out in the high quality space for now and then wait for these opportunities to develop out the credit risk spectrum.
Here's the latest. Big tech issuing a record amount of debt to meet costly AI demands. Laura Mayfield, Vice President and Senior Portfolio Manager at Fort Washington Investment Advisors, writing, hyperscalers are investing heavily in AI today, but their revenue sources are broad-based and their viability doesn't hinge on any single AI outcome. Laura joins us now. Laura, wonderful to see you. Thank you for being here in the flesh. One question here is, can you get behind some of this issuance? Because even if they have the revenues, they're levering up at a time of some speculation about the cash needs and, frankly, the end use case.
Yeah, it's a great question. And I think there is valid concern about the monetization of those investments, the sheer volume of that investment. But ultimately, these are very broad-based. These companies have very broad sources of revenue. We analyze them as we would any other corporate credit. Leverage is modest and manageable, debt service coverage as well. So, unlike on the equity side, where you have to be correct not just about the trajectory of this investment playing out, but also the timing of it, I think we're much more comfortable on the corporate credit side with these very high-quality issuers.
It raises an issue, though, of the change in composition of the overall investment-grade debt market. You've seen a record, some $66 billion, or a significant amount of issuance from these tech companies. The AI-related IG issuance so far this year, this according to Torsten Slok, has jumped from 70% in 2024 to 14% in 2025. Does that make you think again about the concentration risk of the investment grade index?
It definitely does. And not just the concentration risk within investment grade corporate credit, but more broadly across the economy as a whole. We know that so much of the equity market growth has also been driven by this investment in AI and data center infrastructure development. We know that in turn has been driving some of the consumer spending, the higher income cohorts that have seen their wealth portfolios grow with this market growth. All of that hinges back to this strength of AI and the heavy investment in AI infrastructure development and data center build out and so forth. So I do think it is concerning. We have a lot of eggs in the same basket here.
Laura, good morning. It's Guy in London. Do you think, given the scale of the issuance that we are going to see, that yields will remain higher?
I think there are concerns around the demand for the ability of the market to absorb the increased supply. I think that we could see spreads under pressure a bit. I think, we don't have an outlook for a fundamental a recession per se, but I do think the increase in supply and the amount of demand that has to be created to absorb that supply specifically around AI and data center investment, I think we could see spreads come under pressure. So I think that, all-in yields could be a bit inflationary as far as, driving prices and pressuring prices.
Yeah. How careful are you being? Like, what's the difference between Oracle and Amazon? What's the difference between Oracle and Alphabet? How careful do I need to be in terms of which corporates I'm looking at?
I think it makes a big difference. You're talking as far as leverage, as far as credit quality, diversification of revenue sources. I think, we're being very particular in terms of how we participate in the hyperscaler credit specifically. That's a much different risk profile than in some of these asset-specific deals in the securitization market, for example, where your outcome and your credit risk is hinging on the success of one particular asset. That's a very different risk profile. Similar with the equity side. I think, we're very comfortable at the corporate credit level. These are very high quality AA rated companies that are investing in this next leg of IT progress. And I think that there's a very valid case for that. But on the equity side, again, you have to be much more careful and much more certain about not just the trajectory, but the timing of monetization of those investments.
So earlier this year, Google sold some $25 billion of corporate bonds, including a 50-year tranche. And we were wondering who's going to buy a 50-year batch of bonds from Alphabet, which has had a changed business model. Yes, it's been a sticky company and has a huge revenue stream. You might have been one of those buyers. Is that right?
Yes, we've been favorable on some of those longer duration issues from the very high quality hyperscalers. We have long duration needs across some of our portfolios, and with valuations being very tight, we're underweight. But we like that high quality supply for some of those longer duration needs that we have to fill.
How much, just going forward and stepping back, aside from just the AI story, do you see disruption in the market, in the economy, that will cause an acceleration of bankruptcies, akin to what we have seen over the past year, frankly, although stealthily? Do you think that's going to pick up even without a turn in the economic cycle?
I think there is risk of that. And, one thing working in our favor right now, I think, is actually the limitation of power availability. I think that's providing a bit of a governor on our ability to overbuild. But I do think there are risks. There's so much capital going into these infrastructure developments, and some of it is being funded privately. So we don't even have, the entire market is exposed to that, but we don't all have the transparency to see how those assets are performing. So I think there is risk that we get out over our skis a bit. And some, Steve Eisman likens it to the build out of the railroad industry, where you had, in some cases, developers building out railroad infrastructure side by side in competition. Some failed and some succeeded. And I think we could see some of that. So I think the question is, with the entire economy, so much of GDP growth is coming from data center investment and also consumer spending, which we know consumer spending is concentrated in that higher income cohort, which has been supported by wealth growth from market acceleration. Also, hearkening back to data center investment, it's like a Jenga tower. All stemming, the very bottom row is all this AI and data center capex. So I think it is very possible, it doesn't take much disruption to have quite a few domino effects that are going to impact the market in a more holistic way.
Laura Mayfield, thank you so much for being with us this morning. Have a wonderful new year. Laura Mayfield of Fort Washington Investment Advisors. As people look to concentration risk, Guy, it's not just in equities, it's not just in bonds, it's frankly in the economy too, as we try to understand the low hire, low fire dynamic and what exactly is going to be going with that.
It's a really confusing market, isn't it? But at the moment, everybody's on the same side of the boat. Everybody's going into next year looking super positive. You talked about where are the vigilantes earlier. Where are the bears in these markets as well? It's too big a ride to get off at the moment. The question is, when it is time to get off, how quickly can you do it?
And that's what we're going to be talking about coming up. Dana Doria of Envestnet, Nicole Bichot of ZipRecruiter, Bloomberg's Enda Curran, and Tyler Bowley of Bank of America Institute as we look to the final days of 2025. This is Bloomberg Surveillance. Good morning.
There's going to be a meaningful correction at some point over the course of 2026.
We want to make sure we're managing risk well next year.
What the market is saying is that earnings matter more than ever right now.
It is encouraging that we are seeing broader participation in the rally.
Investors need to be ready for surprises and the unexpected.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks seeking direction heading into the penultimate day of trading this year, with silver and gold rebounding after yesterday's brutal session. Tech companies keeping busy to end the year, with Meta the latest to make an acquisition, and all eyes on the U.S. economy with some jobs data out in about 15 minutes time. And tomorrow we get jobless claims, all of that possibly shedding light on what to expect in 2026. Guy Jansen joining us from London this morning. I'm in New York. John and Annmarie are both off this week. A real question here, Kai, about how much clarity we can get into 2026 amid a pretty murky backdrop economically.
There's so many things that are unclear at the moment. What happens with the Fed next year? What's going on with inflation? What does that mean in terms of the dollar? Is Europe really going to spend? What is happening on the geopolitical front? There are multiple wars that are still raging that could also catch light and go further. There's so much uncertainty going here. It is stunning that the US economy remains as strong as it is. Is that down to big tech? It is stunning that asset prices remain as elevated as they are. How much volatility are we going to see next year?
Right now, not a whole lot, at least not in the equity space. We saw a little bit of a dip yesterday and the day before, although we are seeing stocks near all-time highs. S&P futures going nowhere, no volatility there, no action there. You are seeing a bit of dollar strength reassert itself. The euro down just 0.1%, 117.61. Bonds selling off. Watch the space because it has built throughout the morning, up about 3 basis points on the 10-year yield to 4.14%. And silver, if you want action, if you want excitement, check out the metals market. Silver up 5.7% after yesterday's biggest one-day loss going back more than 5 years. Silver and gold, best years going back to 1979. Copper experiencing its best year going back to 2009. What is the metal space telling us? Meanwhile, what we are expecting this week, today and tomorrow in particular, we're going to be getting that ADP weekly labor market indicator in about 13 minutes time. That will come out. We'll break that down. Then, of course, at 2 p.m. this afternoon, we do get Fed meeting minutes. Jobless claims come out tomorrow at 8:30 a.m. Eastern. And then everybody takes a well-deserved break on Thursday for New Year's Day. Coming up this hour, Dana Doria of Envestnet, as stocks aim to avoid a 3-day losing streak. Nicole Bichot of ZipRecruiter previewing the labor market for 2026. And Taylor Boley of Bank of America Institute looking back at the top 5 themes from this past year, dissecting what the consumer could be telling us. We begin this hour with stocks going nowhere as traders trim bets on mega cap tech stocks heading into the end of 2025. Dana Doria of Envestnet joins us now. Dana, you did some work on what a Santa rally actually is, looking at how often you usually see gains. Why is it not working this time around?
Yeah, unfortunately, it's not. I mean, of course, we have nothing to complain about, right? That this has been another double-digit year. And, you know, the economy has remained very strong in spite of kind of taking some crazy hits when we look back across the course of the year. So we may not hit that 20%. It's not looking good at this stage of the game, but it's still been a phenomenal year in markets. And I think, you know, it might be too much to expect at this point, you know, and stocks don't really have a catalyst, right? There's, you know, to your point on, you know, kind of Fed meeting minutes coming out later this afternoon, we'll get some interesting content there, but, you know, and jobs report coming out. But I mean, where things stand today, there's not a huge amount that's going to happen in the course of this week that's going to kind of drive stocks forward. I think we probably have to be happy with the phenomenal performance we already received this year.
That probably is too much to ask for people waiting for extra gains to put into their stocking at year end. There is this question, though, about whether we are seeing a true rotation. And that's what you're seeing this morning on the margins. I mean, it is tepid, let's be honest. It's not exactly an active trading session, but you are seeing the outperformance come from the Russell 2000. And you have seen that over the past 3 weeks. Is that something you can kind of sink your teeth into and say it has lasting power?
We'll see. We certainly have economic data at this point that suggests that the Fed saying that there's one rate cut coming next year is low, right? We know Fed funds futures already thinks that, you know, we're going to have more than that. If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more. And if the Fed cuts more, that's great for small caps. And so I think to a certain extent, some of that might be filtering into, you know, the expectation set for that part of the economy. Look, I'm a strong believer in having that kind of diversification in the portfolio to begin with. I mean, obviously, large caps have outpaced small caps this year. But I think if you take a step back and look from just a broad diversification theme, we've had a phenomenal year for diversification, right? International, developed, emerging market stocks, 30+ returns. So as good as it's been in the US market, if you had a diversified outlook in your portfolio, you probably did better. And small caps are around 15%. This is not a bad outcome, right? For spreading your dollars, spreading the risk a little bit, particularly when we know the large cap index is so concentrated. It's so heavily dependent and top heavy on, certain stocks. So whether we're rotating into small caps or we're seeing some of the effect of interest rate chatter, I think it's a great thing to have that kind of diversification in your portfolio.
Dana, let's dig into that a little bit more. Does the dollar continue to weaken in 2026? You've just talked about the fact that maybe the Fed continues to cut. That would imply maybe it does.
Yeah, for sure. I mean, obviously, the dollar's been kind of a release valve here over the course of the last year. And, notwithstanding that, we don't know for sure what's happening with inflation, right? We see a report that came out. The data, we know because of the shutdown, the data, there's questions around that. We want to get back to a place where we're collecting data very effectively, efficiently, as we used to, and getting what we feel is a really solid look at what inflation is doing. And that's obviously going to have a huge impact on where the dollar goes in 2026. But for sure, to the extent that we have interest rate cuts, and by the way, this is just sort of to a large extent getting the U.S. on pace with the accommodative policy we've seen in the rest of the globe, throughout the year as well. So this isn't, it's not to say that this is deterministic, but we have to see where inflation goes. And yes, interest rate cuts, of course, if they're significantly more than expected, will have that impact.
Dana, you talked about the diversification trade. In dollar terms, if I'm a dollar investor, I've made 30% in the FTSE 100 this year, 25% in the CAC 40. The DAX has delivered nearly 40%. The Spanish market has delivered nearly 70%. Are those kinds of numbers for US investors going to be available next year? How much emphasis do I need to put on the ex-US part of my portfolio?
I think, the starting point from an academic perspective, right, if nothing else, first principles here, the starting point is what is the global ratio, right? So MSCI ACWI, All Country World Index, that gives me a great starting point for where I potentially want to have international stocks. Now, of course, coming from a place where it's retail investors, it's advisors needing to keep clients disciplined in their portfolios, which is sort of job number one, you have to measure that to a certain extent. If US is gangbusters next year, and they're measuring against the S&P 500 index, it may be hard to keep them in place if international stocks don't deliver. So to a certain extent, there's a behavioral question here around how much can the person tolerate? What are they looking to as the benchmark against that portfolio? If they're looking to a world index, I think the starting point being the world, that ACWI index that includes emerging markets. But if they're not, if they're really tied to a US view, then maybe you have a little bit of a reduced, diversification hedge there with international, but it's not as big in the portfolio as it otherwise would be because the client just, if US does poorly, they're expecting their portfolio not to do as well. But if US outperforms, it's tough for them to kind of stay put. And, these are just kind of the behavioral considerations. And I'll again say, I think small caps have a place. Both small caps and value stocks over time have outperformed. We haven't seen a lot of that in the last several years, but I think some of these fundamentals, these first principle fundamentals, are good not only for the potential to outperform over the long haul, but also for diversifying, again, what is a very concentrated, top-heavy, index at this point. Yeah, and most people have that in their portfolios, right? Unless you have massive tracking error to the index, you have a ton of AI trade, right? A ton of big tech.
Well, the diversification trade has sort of taken on new meaning every single year as people try to decry the death of the 60-40 portfolio. I just wonder how much you have seen a true shift toward precious metals as a diversifier at a time where you've seen an incredible run so far this year.
Yeah, no doubt. People sort of, it was this barbell kind of approach, right, to how people were putting portfolios together. And so you had, I want to not miss out on the AI trade, but at the same time, the ballast in my portfolio becomes gold or even silver now at this point. I do think what's happening in the retail space as well is more diversification into these sort of alternative asset classes. And a lot of that is happening because of product innovation in the space. So not only commodities, not only precious metals, but private equity, private credit in particular. And a lot of that's happening because there's vehicle availability that allows retail investors through things like interval funds. These are point and clicks. You can't get out of the fund as quickly as you can a standard mutual fund, but you can get in and you can get access to a different return stream. We all know there's correlation there. It's the mark to market that kind of makes that correlation look lower than it is. But at the same time, you are getting access to companies that you're not going to get in the public equity markets. And so what we're seeing in the retail space is massive interest in sort of, to your point, diversifying that 60-40 and doing it with alternative assets now that they're more accessible to the average client.
Dana Doria of InvestNet Solutions, thank you so much for being with us. Happy New Year to you. Right now, let's turn focus and get an update and stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. President Donald Trump reiterating that he'd love to fire Fed Chair Jay Powell. Trump saying he might still fire him for, quote, gross incompetence. Trump came close to seeking the Fed chair's ouster in July, of course, but backed away after a negative reaction in financial markets. He said he'll probably announce his pick for Fed chair in January, and his preferred candidate hasn't changed. Elsewhere, tensions are escalating in the Arab world after a Saudi-led coalition carried out airstrikes on a port in Yemen. The strikes targeted a weapons shipment from the UAE, which is supporting armed groups in the south of the country. Saudi Arabia told the UAE to withdraw its forces and halt its support, saying its actions are highly dangerous. And a high-speed railway company, Eurostar, has indefinitely suspended its cross-channel train services between London and continental Europe due to an overhead power supply problem. The company has strongly advised companies to postpone their trips to another day, despite this being the peak travel season. That's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, the weekly ADP employment data set to cross in just about 3 minutes' time. Nicole Bachot of ZipRecruiter with us to break down the state of the labor market. That's next. This is Bloomberg Surveillance. Good morning.
If Powell chooses to stay, which would be historically unprecedented, then it will mean that there's probably less willingness to cut rates aggressively. If he leaves, it'll give the Trump administration one more seat in which they can potentially remake that committee and potentially then advocate for lower rates. History would suggest that Powell will step down, but this is indeed his decision.
That was Mark Cabana of Bank of America as the race to replace Fed Chair Jerome Powell heats up. That conversation ongoing. The likely successor to be announced probably early next year. Right now in markets, you are seeing a churn across the board. Equity futures going nowhere, at least at S&P and NASDAQ, essentially flat. You are seeing yields higher, though. Watch this space. 2 basis point increase on the 10-year yield, 4.13% in silver, gaining almost 6% after yesterday's sell-off of the biggest going back to 2020, as a real question emerges about what silver and gold are coming up. For time now for the morning calls. First up, Baird reiterating its outperform rating on Tesla with a $548 price target. The firm recommending owning the EV into the new year. It continues viewing the company as a core holding. Those shares up 0.8% despite discussion currently about waning demand. Next up, Raymond James removing Shake Shack from its analyst current favorites list, given softer industry trends through the fourth quarter. Raymond James continues to have a strong buy rating on the shares with a $150 price target. Those shares lower by 2.2% in pre-market trading. And finally, Barclays raising its price target on Johnson & Johnson to $217 from $197 and keeping an equal rate rating on the shares. The firm seeing upside to Q4 consensus estimates. Those shares essentially flat. Turning to the economy, weekly ADP employment data not crossing yet. Bloomberg's Enda Curran joining us now. And hard to know what to do with this data, but heading into this, how clear of a look have we had on the U.S. labor market picture?
It's obviously a volatile period right now, at least as you know, around the holidays between the ADP today, of course, the initial jobless claims tomorrow. There's lots of noise in those figures. What we do know, though, is that clearly the labour market has been softening. We had the official read recently showing the unemployment rate went up to 4.6%, the highest in a couple of years. But still, where the tension in this story is, Lisa, is over whether or not we are now seeing a significant slowdown with broad-based layoffs, or whether it's still kind of isolated, pocketed examples of, even though they're well-known brand-name companies announcing job cuts, that's not necessarily translating into wide-scale job losses in the broader labour market. So I think right here, right now, the story hasn't changed much over the last couple of months, really. It's that, yes, the labour market's softening. We know that policymakers are worried about it, but the big debate going into 26 is just how weak it is. And that won't be resolved, I think, in the near term by these private sector data.
Well, the private sector data is supposed to come out at 8:15. Hasn't come out yet, but we will catch you up on it as it does potentially cross and occur, and stay close as we do wait for those numbers. So turning to the labor market picture, we want to speak with Nicole Bachot of ZipRecruiter, who wrote, "The low hire, low fire environment that defined much of 2025 will persist into early 2026, but with a crucial difference. Employers are preparing for growth, not just survival." Nicole joins us now. Nicole, thank you so much for being with us. So let's get into that, this idea that you could start to see a revival of a labor market that has been pretty murderbound for the second half of this year.
Whatever movements we see in 2026 will be gradual. This is going to be slow and steady wins the race here. Instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up as clarity kind of comes into view around policies like inflation and tariffs and how these factors are going to continue to impact employers into the new year.
Nicole, who's going to be employed in this next phase? Is it going to be graduates? Is it going to be workers on AI data centers? Kind of where is the growth going to come from?
We're not seeing AI really reshaping where people are working. We're really seeing AI right now impacting the labor market in how certain roles are showing up. Workers who are able to utilize AI to increase productivity, to streamline their processes, that's where we're going to see the most demand. And we're already seeing employers start to focus on upskilling their current workforce, and employers who are able to remove unnecessary barriers to make it easier to integrate AI into their workflows and to train employees on how to use those tools properly. Yep. That's where we're going to see the biggest hiring bumps into the new year, is employers who are really going to be able to take advantage of those movements. When we look at the new grad side of the house, we have seen, obviously this is a really challenging labor market for new entrants. There is evidence from some surveys that we've done at ZipRecruiter that employers are eager to hire more new grads into the year, more early talent into their pipeline that has kind of been missed over the last couple of years, as focus has been shifted away from those higher tenured roles into earlier processes in the labor market.
What does this mean for wages?
Wages will likely start to stagnate across 2026. We've seen wages and inflation kind of converging together over the past several months. As inflation continues to cool, wages will likely continue to come down from where they're at. We saw around 3.5% annual growth in the last labor market readout, and we'll likely see that continuing to slip a bit into 2026 as well.
How much, Nicole, are we starting to see the employment picture move away from healthcare and some of these defensive areas that need bodies and go to more growth areas? I'm thinking of services. I'm thinking of manufacturing. Are you starting to see any of that shift whatsoever?
Quite the opposite. We're still seeing healthcare being the dominant industry, as well as construction and other manual labor and skilled labor trades. Healthcare is going to continue to dominate throughout 2026 and beyond, especially as the U.S. population continues to age. There will be more demand for healthcare services, especially support roles like nursing and home health aides, as we're seeing the population demographics kind of point towards a more bulk in that workforce for the future. So we will continue to see those manual and skilled trades kind of pushing up the labor market, and the cyclical cycles of of industries where we look at manufacturing and retail, those are going to continue to stay stagnant while employers are figuring out how tariffs are really going to be impacting their business lines moving forward.
Taking a step back, Nicole, when we take a look at 2025, a lot of people will say this was the year when suddenly the labor market was buffeted by a secular trend with artificial intelligence and companies not wanting to hire, particularly entry-level jobs or in entry-level positions, because they could see potential efficiencies with technology. Do you have any evidence to back that up? Do you think that that's going to become an even greater story in 2026?
I don't. And I don't know that there's a lot of evidence that really points to AI being the actual reason, whether that's in the headlines or not, being the actual reason for a lot of the slowdowns in hiring we've seen. It's a convenient excuse for low hiring, given a lot of the other factors going on in the macro environment that are impacting businesses right now. When we look ahead to 2026, there's a lot of room for AI to continue to reshape how workers show up to their jobs, but there's so much work that's not able to be taken over by AI, especially not where we're at right now. So this is still going to be a gradual pickup to where we see AI really, hitting its stride and taking over a lot of the automated tasks in the workforce, but that's not necessarily what we're seeing right now.
Nicole, the Fed has delivered a series of rate cuts, which were labeled insurance cuts, insurance about relating to a labor market that was apparently slowing down. A, were those insurance cuts required? And B, if they were required, what effect have they had?
Unemployment has been rising throughout the second half of 2025. So the cuts intending to stabilize unemployment, did come at the right time. But the goal of those cuts is to stimulate more hiring activity, and we have not seen that happen yet. We haven't seen businesses be able to translate those lower rates into actual hires and more job growth. That hopefully will come in the next couple of months. This is also coming at a really challenging time, as you all know, with this big kind of data blackout and murky data situation due to the government shutdown. So as we look ahead to next week, where we're anticipating a new jobs report and JOLTS report to look at how openings and job growth look towards the end of this year, that will really help to clarify, whether or not we're actually seeing those cuts do what they're intended to do, or if we're still seeing a lot of stagnation as tariffs and sticky inflation continue to take hold of employers.
Nicole Bachot of ZipRecruiter, thank you so much. And a quick note, it appears that the ADP data will resume at the beginning of the year. It is not coming out right now. There is this question, Guy, and I wonder what you've heard about this, but a couple of people in private conversation said that one reason why there just wasn't a lot of hiring wasn't anything to do with artificial intelligence, but just was people didn't like the stock coming out and they kind of wanted to sit on their hands, especially after overhiring during the pandemic, and that had more to do with it than anything else.
I think the problem is we don't know, Lisa. And I think this is the issue that we're all facing right now. We've had these Fed rate cuts, which were insurance cuts designed to insure against who knows what. The labor market, it's showing some weakness, but we don't know why. So it does feel as if we're going into next year with a huge degree of uncertainty around A, inflation, and B, the labor market. The Fed's already delivered a series of cuts designed to maybe stabilize one. If those turn out to not be necessary, what does the trajectory look like?
Yeah, well, this is what a lot of people are wondering, especially given that the data has been so muddy that we have gotten. Coming up in just a bit, you hire on and back with your morning movers. Freeport-McMoRan shares rising on the heels of copper's record run, the longest run going back to 2017, the biggest yearly gain since 2009. This is Bloomberg Surveillance. Good morning. Quiet morning, the second to last trading day of 2025. You are seeing little action when it comes to equity futures, certainly the S&P and the NASDAQ. Right now, doing nothing. You are seeing a Russell 2000 up about 0.1% in the bond space, 2s, 10s, and 30s. You are seeing a bit of a sell-off, particularly at the longer end, although clawing back from some of the earlier declines that we had seen. Yields higher by 2 basis points at the long end to 4.82%. In the metal space, this has been the action for the entirety of the last couple of weeks. We see silver, we see gold, we see copper, all of them inflected upward as that rip-roaring rally continues for the year. You've seen the best yearly gain for gold and silver going back to 1979. 1 hour away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Freeport-McMoRan, a major copper producer here in the U.S. Shares are up 2% in the pre-market as copper heads for its 8th straight day of gains, the longest winning streak since back in 2017. And the strong run this year has been driven by the threat of U.S. tariffs. Traders have been rushing copper to U.S. ports in order to get ahead of those potential levies. It's tightened supplies elsewhere, and that has led to a more than 40% rally in copper this year. Sticking with precious metals, because as you said, it is the story of the morning and the past few weeks. We have the world's largest gold miner, Newmont. Shares are rising 2.2% after falling 6% yesterday, tracking gold's slide from record highs. Though with the precious metals rally back on this morning, we are seeing these miners tracking those gains. And we end on another company benefiting from a major theme this year, AI. Applied Digital shares are up 2.3% in the pre-market on news that the data center company is spinning out its cloud computing unit and merging it with another company in an effort to streamline its business. This is a stock that investors have loved this year due to its role in the AI infrastructure build-out, with shares up more than 200% year to date. Lisa.
Thank you so much, Yahira, and Happy New Year to you. Turning to the Federal Reserve, President Donald Trump has his pick for the next Fed chair, but is in no rush to announce his decision.
You've said that you have one favorite, but you're also doing interviews.
Still do. Hasn't changed. Yeah, I'll announce him at the right time. There's plenty of time.
President Donald Trump adding that Powell, quote, should resign and that he'd, quote, love to fire him. Bloomberg's Enda Curran back with us. Taking a step back from the drama that is who is going to become the next Fed chair, there is this larger question about how significant of a role the Fed plays in the U.S. economy next year. Do we have a sense of how interest rate sensitive this U.S. economy still is?
I mean, clearly there are pockets, Lisa, that remain interest rate sensitive, some that aren't, of course. You could argue that the AI build-out is sort of happening quite divorced from what's going on with monetary policy. But you could argue those people who have car loans or who are trying to get in the housing ladder or maybe even have lost their job, those people certainly would welcome lower interest rates. I think no matter where you stand on that, the key sort of metric for the story, for the monetary policy debate next year in the US is going to be about the jobs market. If we continue to see the jobs market weakening, maybe even materially, at a time when inflation continues to cool down, then it will be hard to make the case that rates should stay where they are and that they shouldn't go lower. And I think that's going to be the key metric. The Fed themselves have noted they might be near that neutral territory, but clearly they've left the door open to further easing at some point. It's a question of what the data says and when they might do that.
And I'm just wondering what you're looking for when we get the meeting minutes from the previous Fed confab later this afternoon. What do you think is going to be most important to see?
I think, very simply, will it reinforce the idea that the Fed will stay on hold when they meet in January, Lisa? As you know, that December meeting a few weeks ago, a 9-3 vote, very divided on the outlook. We had a signal in the statement suggesting that perhaps policymakers might be on hold for now. We had those comments from Chair Powell afterwards in the press conference making the point they're closer to neutral, maybe hinting there that they might be on hold for now. We know policymakers are very divided. We see that in their forecast for the year ahead. Some, like Governor Myron, looking for bigger rate cuts. Others like Austin Goolsbee, of course, suggesting that they need to stay on hold. But one thing is worth noting, Lisa, is that the data hasn't really cleared up anything in the debate about inflation versus employment since they met. I mean, we had unemployment data since they met suggesting unemployment has risen up to 4.6%. OK, that's worrying on that side. But we also had the Q3 GDP data, which suggests that obviously very strong growth, which you could argue might lend itself towards the inflation side of that debate. So it's a divided outlook. It's a muddied outlook. I think the least we'll be looking for from these minutes today is just whether or not policymakers want to sit out that January meeting.
Andy, good morning. It's Guy. We've had insurance cuts. Now, generally when you buy insurance, you kind of haven't had the event that you're buying the insurance for. Where are we in that kind of how much is necessary to stabilize the economy debate? We've had a whole load of rate cuts. Is it enough? How much more would be required to have an impact on the labour market? We were just talking to ZipRecruiter. Not much of an impact seems to be the consensus at the moment in terms of the effect that those cuts have had. When do we start to see the effect of them?
Yeah, good morning, Guy. I think it takes a while. So 75 odd bips worth of cuts this year in the US. As we know, it takes some time for that to pass through the economy. And of course, as Lisa just highlighted, some sectors won't even be impacted by that at all. You talk about the housing story. We know if you have a mortgage right now, you're probably not going to be looking to move or sell your homes, for example. So that's going to stay removed from where the rate cut story is going. The AI boom is carrying on regardless one way or another, sort of divorce from what's happening in monetary policy. But again, I think when you talk about those pressured parts of the economy, like the small businesses who need new loans, who need refinancing, those who are looking to get on the housing ladder, those who are in the variable rate loan space, the auto loan space has been back in the news. Those people clearly will be welcoming the lower borrowing costs that the banks offer them. But again, it's critical what the market yields do, Guy. And of course, it's critical in terms of how much further the Fed goes from here. So, it's not a game changer for the economy, but it's trying to get ahead of the curve, I think is what the Fed is doing.
How big a danger is there that if the Fed cuts too aggressively, that mortgage rates go up, not down?
Well, that's the big talking point at the moment. I mean, and this is the big, Chair Powell has made the point there's no risk-free path here. One of the big concerns is the trajectory for US borrowing, and that's said to be keeping some upward pressure on yields. The Fed rate cuts haven't really had much of an impact on market yields so far, and that's, of course, what drives the loans that people take out on Main Street. I think a lot of it will come down to credibility. Who becomes the next Fed chair? Will they be willing to steer the Fed on the basis of what the economy needs rather than what the politics of the day demands? And what will the data be saying? As I say, if inflation is continuing to head back towards target, clearly and consistently, and unemployment is, if not holding where it is, softening, then there's clearly a case that the Fed can lower interest rates. But if that's not happening, then that story becomes very complicated very quickly, and that's where you start to see the market reaction, and that's where I think everyone will be looking very closely to see how yields will respond to what both the data and the Fed are telling them as we go through next year.
Enda Curran, thank you so much for being with us, as always. Sticking with the Fed, National Economic Council Director Kevin Hassett has told President Donald Trump he would accept the nomination to replace Jay Powell as Fed chair if the job was offered. Hassett appeared on the David Rubenstein show Peer-to-Peer Conversations last month at the Economic Club of Washington, D.C. to discuss the possible role change. Take a listen.
So you may have noticed the president was calling on the chairman of the Federal Reserve to lower interest rates. And
really? He did?
Yes, he did.
Oh.
And interest rates have been lowered. The last time the Federal Reserve FOMC committee met, they lowered by 25 basis points. There's a wide expectation that the Federal Reserve Board might lower again in December. Do you have a view on whether, if the Fed does lower it, should be 25 basis points or 50 basis points as the president, or do you have a view on what might be better for the economy?
Well, I first want to say that I have high regard for Jay Powell. I've known him for a long time, have had economic conversations with him many, many times during the last administration and this time, too. I think at times he and I have had policy disagreements.
You think it's more likely to do 50 than 25?
No, I think they're not likely to do 50.
50. More likely to do 25? Would that satisfy the president, do you think?
I think that the president thinks rates could be a lot lower, and I agree with him on that.
You are one of 5 people that the Secretary of Treasury has on a short list to be the next chairman of the Fed. Why would you want to be chairman of the Fed? Right now, you get to work with the president every day, and he's not criticizing you at all. So, are you sure you want that job?
It's a thing that, first of all, I have to say that I, as you know, feel like I'm the luckiest economist alive, because I have the best job I think an economist could possibly have if you spent your life doing, economic policy, unless you're a monetary theorist. Being director of the National Economic Council is my dream job. And if the president asks me to be Fed chair, then I'll do it. But if I'm not Fed chair, don't be disappointed for me, because I love the job that I have right now. And I'm so honored to be able to work with the president every day.
Do you have any view on when the president might make the decision or make it public? Would it be this year or next year?
I don't have a view on when the optimal time for that is, and I've not discussed that with the president. I think that people in Washington will understand that a confirmation struggle for a position that's that significant can be quite difficult. And then if it goes on for a really long time, which so we think Jay probably isn't leaving until May, then that just creates like a long period of confirmation struggles that can be pretty ugly. And so I don't know what the optimal time is, but I would guess that as soon as you do it, then the sort of confirmation turmoil will begin.
Most presidents in the last 25 years or so have supported, and secretaries of Treasury have supported what is called a strong dollar policy, which is to have the dollar be really strong and never support anything that would lower it. Is it fair to say you do not have a strong dollar policy, or are you happy where the dollar is now?
If you look at the dollar chart, then it's stronger now than it was when Trump left office, but it's down a little bit from its peak. And I think the strong dollar policy is a sound policy. And I think that, basically, I'd almost say that if I were running any country anywhere, I would want the currency to be sound because we know what happens to countries when the currency isn't sound. And so I think if you want to have, an inflation take care of your deficit, then you're on the road to financial crisis. And so I think that one of the ways that we can maintain fiscal discipline is to be really committed to a strong dollar.
Right now, the budget deficit has generally been for the last couple years about $2 trillion a year, more or less. More or less, we spend roughly $7 trillion a year. We take in roughly $5 trillion a year, and we generally have about $2 trillion deficit. Maybe it's coming down now, but we have about $38 trillion overall of debt. Do you see any way to reduce that indebtedness in the next couple of years or so, or realistically, we're stuck with $38 trillion or rising a little bit over the next couple of years?
Right. Well, to reduce the debt, then you have to run a surplus. And so the question is, do you reduce the debt relative to the target or not? And we clearly are doing that with the big reductions in the deficit right now. And so I think that those will continue. And I'm also extremely bullish about growth. But it's not just growth that's doing it. It's the fact that we have tariff revenue and we've got a lot more spending restraint than was here in the past.
National Economic Council Director Kevin Hassett on the David Rubenstein Show. Peer-to-peer conversations. Do not miss those. Always wonderful to listen to. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. President Donald Trump says that the U.S. struck a facility inside Venezuela in what would be a significant escalation in its campaign against alleged drug trafficking operations there. Trump's reference to an attack within Venezuela would mark the first time the U.S. has announced a land strike in the country. Elsewhere, the controversy over President Donald Trump's name being added to the Kennedy Arts Center is continuing. The New York Times reporting a veteran jazz ensemble and a New York dance company have both cancelled events for New Year's Eve. This follows the cancellation of an annual Christmas Eve jazz concert. The Times reporting that the Kennedy Center chairman says the artists cancelling shows were, quote, far left political activists. And in sports, the Atlanta Falcons stunned the Los Angeles Rams 27-24 in the final Monday Night Football game of the regular season. Falcons star running back Bijan Robinson racked up 229 total yards and 2 touchdowns in the victory. Kicker Zane Gonzalez nailed a 51-yard field goal to seal the upset. And that's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie, and thank you so much for this morning. Up next, setting you up for the day ahead, plus Taylor Boley of the Bank of America Institute breaking down the top 5 themes from this past year. Don't miss that. This is Bloomberg Surveillance.
What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026. It's going to be a very confusing data landscape. And I think people have this idea that the tariffs are behind us and that the uncertainty from tariffs are behind us. That is not our view. We think that uncertainty is going to prevail next year. And again, one of those signals from that high retained earnings shows that firms are paralyzed. They're uncertain. What are they going to do with this profits? And I think that's the answer to that question is going to be the answer to the contour of the economy.
That was Constance Hunter of Economist Intelligence at a time where there isn't a lot of clarity, and right now markets aren't really doing that much, certainly not the equity futures that have been range-bound throughout the morning. It's supposed to be the Santa rally time, and we haven't seen it over the past two sessions. Today, fading just a little bit. Futures lower by about 0.1%. You are seeing just a touch of a sell-off in the bond space, but nothing major. 2 basis point increase, 4.13%. And silver gaining after yesterday's sell-off, up 4.8%, reclaiming some of those record highs, counting down to the opening bell. Here's the trading diary for the week ahead. 2 p.m. Eastern is the big event, Fed meeting minutes. Tomorrow we get jobless claims and enhanced healthcare subsidies that are set to expire. On Thursday, congratulations, you made it. Welcome to 2026 and have a day off. As we prepare to ring in the new year, one narrative that has been central to 2025, the Bank of America Institute writing, economic resilience has been a key theme, although affordability looks different across households. A K-shaped recovery emerged in the second half of the year. Taylor Boley of Bank of America Institute joins us now. Taylor, thank you so much for being with us. Happy New Year, happy holidays. I want to start with some of the themes that you have seen, and really the consumer resilience has been a theme that has pervaded the entire holiday shopping season, even within that K-shaped rubric. What has been behind that consumer resilience?
Yeah, absolutely. I would say resilience is one of the key words when I think of 2025. And the consumer spending element of this has been really interesting because in the first half of the year, things were a little rocky. And what we've seen in our data, which, mind you, we look across nearly 70 million consumer and small business accounts, so we can really see in real time how consumers are reacting. And what we've seen is in the second half of the year, pretty strong spending growth. And thinking about the holiday season, it was really interesting. I mean, you could see that consumers were splurging some, but they were also being more selective in what they were actually buying. So there was a little bit of pullback around some services like restaurants or airlines, and just more of a conscious consumer and saying, okay, maybe I'm going to be more savvy when I'm shopping online and looking for certain items.
Well, this raises this issue of how much some of the retailers can pass along price increases, because we've seen them say that they plan on doing that early next year. And yet what you're saying is that people have been pretty smart about their shopping, right? They've been really selective. Has it been price driven, or has it been region driven, or has it been just depending on what kind of income level you're at?
I mean, we've definitely seen, and you touched on this, right, a K-shaped recovery. And within our data, we have seen that higher income household spending has taken off, whereas lower income spending growth has lagged a little bit. And part of that story goes back to wage growth, because at the end of the day, ultimately the people that are bringing money home, that's going to determine what they can actually budget, what they can allocate towards. So what we're seeing is that even during holiday shopping season, higher income spending growth was outpacing that of lower income.
One thing that Torsten Slok over at Apollo noted, and he just put out a chart over the past couple of days showing that income growth has actually exceeded inflation over the past couple of months. And it really kind of points to this question around small businesses and how much they need to do well in order for the consumer to continue powering the economy. What have you seen when it comes to small businesses and their ability to keep expanding, hiring, and passing along some of their profits?
Yeah, in small businesses, you know, there's this understanding of, okay, how is Main Street doing versus Wall Street? And Bank of America has been the top small business lender for the 17th quarter in a row. So because we're providing these small businesses capital, we have a really unique insight into how they're spending, how they're growing, how they're managing hiring. And what we've seen is the tariff impact has been there. And that's led to, even though profits are still positive, the rate at which those profits are really happening is starting to slow. And that also is the same when we look at the small business hiring landscape. We have an indicator that says, okay,
how often are small businesses really hiring? And it's about a month ahead of JOLTS. And what we've seen is that it's about 4% below the 2024 average level. So what that tells us is that this theme of a cooling labor market is hitting small businesses.
Well, just again, this sort of speaks to a bifurcation in the economy right now, where some people are saying, just take a look at third quarter GDP. It was a significant expansion, the fastest going back 2 years. Take a look at what the AI investments have been. Wow, it really is powering this economy ahead. And then you see small businesses and they really aren't feeling it. They're not passing it along. So which theme is going to be the one that you think is going to really take precedence in 2026?
I mean, we talked about 2025, keyword being resilient. I think 2026 is really about adaptability, how small businesses are handling the policy landscape, how consumers are also reacting. And of course, on top of all of this, for both consumers and small businesses, is the shape of the labor market. And what we're seeing in our data is that unemployment payments is kind of holding steady. There's not a sign of a total collapse, but there's certainly a moderation and something to look out for as we head to the new year.
Taylor, thank you so much for being here. Wonderful to meet you and to catch up with you heading into the new year. Taylor Bully of the Bank of America Institute. We appreciate you being here. Guy, this is something that people talk about heading into next year. Which story is really going to take precedence? Is it going to be the AI story and some of the gains that it drives? Yep. Is it going to be the real economy where you haven't seen the kind of gains catch up, the sort of K-shape that seems to pervade every discussion that we have?
How important the stock price is going to be in this? How important is the wealth effect driving that upper part of the K? If you start to see a crack somewhere, does it turn into a crack elsewhere? There's so many questions. There are very few years I think we've gone into with this number of questions, this level of uncertainties. The Fed's given us a bit of an insurance to wrap around it. But is it going to be enough? We don't know. Has the Fed gone too far? We don't know yet. Which is going to be the biggest theme next year? Is it going to be unemployment or is it going to be inflation? And all of that's going to take us into the midterms, Lisa, where the affordability story is going to be front and center. Can Trump have rate cuts and a resolution to the affordability crisis all wrapped up in a nice, neat bow? Can the Fed deliver that? I just don't know how much of this is going to be resolved quickly and how investors are going to position for it. At the moment, everybody's on one side of the boat, and that's positive. Do we get more volatility next year?
Well, right now, people are positioning for future gains with a host of bulls on Wall Street. Guy Johnson, always wonderful to have you on the show. Thank you so much for being with us. Wonderful to have you. Right now, what you are seeing in markets on the second to last day of the trading 2025, you are seeing range-bound activity in S&P futures down about 0.1%. The NASDAQ actually building on losses down 0.2%, and the Russell 2000 giving up. In the bond space, you have seen just a little bit of sell-off. Guy was talking about this question around the Fed, how much control they have over the long end with the sell-off continuing there. 30-year yields ending above where they were to start the year. They started the year at 4.77. They're ending the year almost the same place, 4.81%. You have seen gains, declines in yield for both the 2-year and the 10-year. Don't miss the space of metals, what you're seeing there with gold, silver, copper, all building on gains so far this year. Coming up tomorrow, Michael Purvis of Talbot and Capital Advisors, Michael Reed of RBC, Barbara Duran of BD8 Capital, and Claudia Som of New Century Advisors as we take you into 2026. This was Bloomberg Surveillance. Good morning.